customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
have a great evening.
Here's what I'm watching.
You do not want to miss this
He's
story.
there, the kind of upside.
Do you really think we need another rate move to bring down inflation?
Too early for me to know. I think there are a wide range of possible outcomes. You could argue for a resurgence based on the numbers we've been seeing. You could argue for a downturn, as you've been talking about. And you could argue for a return to the pre-COVID economy. I think all of those are in sight.
That was helpful. Thomas Barkin, the Richmond Fed president, sitting down with Bloomberg's Mike McKee. Mike is one of the best. The range of outcomes they still see on this FOMC TK is just phenomenal. They tell us that the soft landing is not the baseline, it's still the objective. But you just go through these outcomes. Let me repeat what Barkin just said to Mike McKee. You could argue for a resurgence based on the numbers we've been seeing. You could argue for a downturn, as you've been talking about, and you could argue for a return to the pre-COVID economy. I think all of those are in sight.
That's a business guy and consultant setting up the choice set or optionality they have forward. And because we're America, unlike other central banks, we have larger degrees of freedom to wiggle around depending what the data is. Barkin's just going to wait to see what the data is.
And given that, Tom, when they see the three potential outcomes that way, what do? You just wait, don't you? That doesn't sound like a guy that's got tons of conviction to do something.
I'm on a warpath today about people blathering on about guesstimating and forecasting what the economy is. You know, everybody's going to publish this weekend. Gaping over at Bank of America, Hatzius, Goldman Sachs. Everybody else is going to publish, and I really care what they think because they're working 24/7 on this stuff.
Well, at a certain point, you have to come up with a base case. If the base cases are so wide and you can drive a truck through it, it raises a question about volatility and how you price volatility and why it's not being priced in more aggressively, both in yield premia as well as...
What have spreads done this week?
They've actually climbed considerably.
They've widened out, showing more fear.
Exactly. So you are feeling a little bit of that on the margins, but at a certain point, the volatility in and of itself is something people have to start to price.
I couldn't agree more. TK, I'm not sure they've got a base case right now, and if they have, they're not sharing it with us. Based on the forecast we got last week, which screamed soft landing, if you think we can get inflation down to 2%, 2.0 flat, with unemployment not climbing much higher than 4%, then you're in the soft landing camp. The problem is, I'm not sure he wanted to spend too much time talking about the median projections, TK, at the Federal Reserve based on the performance we saw in the news conference last Wednesday.
One of the things we learned in Jackson Hole was they drive out west. You know, you go out for a quart of milk and you drive 40 miles and that's no big deal. You know, you go into you need a beverage, you go into the $1 Million Cowboy Bar and it's an 80-mile trip there and back.
Driving past
it's
the
not
bison.
like New York, you know. Yeah. A gallon of gas matters, right?
It does.
It does matter. And right now, a gallon of gas is going up. John, what do we got here? We got West Texas Intermediate, $92. Brent crude $96 a barrel. Joining us from the most expensive gallon of gas in the nation, Los Angeles, Stephen Shork. He's principal of the Shork Group with incredible microanalysis of the distillates. What's a jet fuel look like at JFK or LAX? How diesel-y is diesel? Let's go there, Stephen, into the weekend. Worldwide, diesel's upset. Why is diesel, that goes in my ancient VW Rabbit, why is diesel topsy-turvy?
Well, absolutely, because it's the least market where you'll see a margin for refineries. So a refinery, their goal is always to maximize the amount of gasoline that is being produced. So distillate or diesel fuel always comes in second place. Now, with the way they've shifted from a government policy, from a taxation policy, there is a market that is under strain. Right now, we're going into the peak demand season for diesel fuel. So you have intermodal demand here in Los Angeles, in Southern California, with all of the freight that comes into the ports of Long Beach and Los Angeles. Those goods have to be shipped to shelves to get ready for the the Christmas season. We also have the harvest now in the Midwest, so there's a tremendous amount of demand for off-road diesel. Supplies are just really low, Tom, and when you have low supplies, high demand, there's only one way for prices to go.
I believe oil's up, and the Steve Shork world is not up as much. Do you just assume a gallon of gas catches up with where Brent crude is?
Absolutely. And what's scary about this, Tom, is we're now consuming winter-grade gasoline. This is a gasoline that has a higher vapor pressure. It is cheaper to manufacture, and yet prices are at record highs for this time of the year at the pump. I'm afraid now, with the situation we're seeing in supplies, crude oil supplies, at the NYMEX delivery hub in Oklahoma, we're at very low supplies. There's going to be a tremendous strain on the market, already is. We're seeing it now in the front end of the curve, a tremendous amount of premium called backwardation. Today's price is greater than next month's prices. It's a clear signal that the market is undersupplied. There's too much demand. And again, we'll need prices to go even higher here to even out and bring this market back into equilibrium.
Stephen, are you saying this is almost like the opposite of what we saw back in the pandemic?
Yeah, absolutely. That was a situation where you couldn't put any more barrels of crude oil into the delivery hub, and hence owners had to pay to get that oil out of there. So right now we have a situation where over the past 3 months, oil inventories at the NYMEX hub have been slashed in half. Now we're only at about 21 million barrels in those tanks. The capacity is closer to 80 million barrels. The problem here, Jonathan, is we're only about 2-3 million barrels away from what's called tank bottoms. Tank bottoms is the sludge at the bottom of the tank. So we are now really plumbing the dregs. And that is a concern because there's already issues with regard to the quality of that oil. So if we don't have that quality oil sitting in tank, or we're draining whatever is left there, and what we're seeing on the front of the curve, there certainly is an incentive to take even more barrels out of cushion. Then it gets into an issue of quality over quantity, we'll have neither. And once again, that's sending a tremendous ripple through the market and helping to support prices and making a case for oil prices going to and above $100 a barrel through the end of this month and certainly by the end of this year.
So, Stephen, just help me a little bit more to translate some of this stuff. When we saw that data out of Cushing earlier this week and we heard that phrase, operational lows, is that what you just described?
Yes, absolutely. So in any tank, you can't drain it down all the way to the bottom because there is that, it's called BS&W, basic sedimenting water. And this is the stuff that kind of floats to the bottom and just sits there. So you have to have a level of oil above that. Operational levels, the sales line is another way to call it. And once we get down to that sales line, and we're pushing up against it right now, you're running into an issue is we don't have enough oil sitting in tank right now.
Stephen, I look at where we are and all the micro analysis that we do. Do we have an energy policy wrapped around the Shork report? 8 pages of distillate, what is New York Harbor, all this romantic oil, petroleum stuff. Do we have an energy policy arching over the Shork report?
I've been trying to search for an energy policy for this country for the past 2.5 years. Unfortunately, I don't have a lot of confidence in the policy that we're seeing. And as we know, we have a head of the Department of Energy who doesn't even know how much oil we consume on a given day. This is not where their priorities are. So we do not have an energy policy. And therefore, you've got a tremendous amount of volatility, and it's better to own oil. And look, we know what it is. We're using the SRPR, that is the Strategic Re-election Petroleum Reserve. We've robbed that reserve of 250 million barrels of oil, and yet gasoline prices today are 21% higher than when we started draining the barrels out of there. So, yeah, there is no policy when you don't encourage domestic production. You go to Saudi Arabia, Venezuela, you ask them to increase production, and yet we have what we have right now. So, yeah, there is no policy. I think they're making it up as they go along.
Stephen, there's one number that contradicts some of that, though, and it's 12.9 million barrels a day of production in America. We're close to all-time high, Stephen. How's that happening? How are we having these problems with that happening?
Yeah, because it's not necessarily about oil, and this is the mistake with taking crude oil out. You and I, we don't put crude oil into our cars. We put gasoline into our cars. We put diesel into our trucks, so forth. So the problem is not necessarily oil per se. It is our ability to refine that oil into what we need, and that's what we don't have. We do not have enough capacity to make enough gasoline, to make enough distillate fuel. So right now, to your point, the industry is doing everything it can right now. 12.9 million barrels with these prices. I'm sure we're going to go up over 13 million barrels in the weeks ahead. Production, the refineries are running at over 91% capacity. That is at a very seasonal high for this time of the year. And we are churning out an above normal 1.11 gallons of gasoline for every 1 gallon consumed. So the industry is doing everything it can to get supply to the market. But again, we are stranded because demand is outpacing that capacity to make more gasoline, more diesel. So what happens? We have to import it. And of course, when you're importing, you have to pay transportation, and that's an extra tax on the commodity.
Johnny's encyclopedic.
Hey, this was a clinic.
It's mind-blowing.
This was a great conversation. If you just caught the tail end of it, we'll post that on Bloomberg.com and, of course, on a Bloomberg terminal. Stephen Schork of the Schork Group, live from New York City. Equities up. Good morning.
We have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
Venture capital, it's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
When you go through a period when it's super easy to raise money for any purpose or no purpose, and you go into a period when it's difficult to raise money even for a good purpose, clearly many more companies are going to founder.
covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
Bond yields are being pinned because the Fed is talking tough at this point, and the market realizes that.
We were bracing for a higher for longer environment with a higher cost of capital.
It's the end of free money, and we think it's a good thing.
I just wonder whether there's a turning point happening now which isn't visible yet.
When you see this kind of volatility, especially in yields, it's the concentration of risks that will cause something to break.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Down on the week, down on the month, down on the quarter. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market is positive. It's up on the session by 0.5%. TK, Q4 just around the corner.
Q4 around the corner. We're going to see tons of research. It's going to be a massive reading in weekend here as we straighten out Q4 and even the view to 2024. Stop the show. Economist of the Week, Ellen Zentner, Morgan Stanley. She nailed the GDP revision, which goes to that uncertainty this morning about, okay, great, what's real GDP going to be? What's nominal GDP going to be? And then what does it mean for the markets?
The problem for the recession calls, Tom, for most of this year is the recession, Lisa, that never was. And this bond market move, I think, speaks to that, particularly at the long end over the month so far.
So then how can we get inflation back to target? And that really is the angst in the market, especially as you mentioned Bank of America, Brian Moynihan's comments earlier this week, saying there's not going to be a recession. The CFO saying basically the same thing. We're hearing that from companies that are able to start re-accelerating their growth and talk about pricing power. So at what point do we get the disinflation that usually comes with a slowdown?
We have it right now.
If we don't get there.
If you take 3-month annualized and not annualized, we are in there is a vector that screams disinflation. To your point, Lisa, the when of it is a mystery.
Do we have the growth slowed down? Do we have the slowdown that you'd see reshaping the labor market with claims still around 200K, unemployment south of 4%?
But this weekend, within all the reading we do, and folks, we don't compare notes here. We all read different things. How many people are going to come out and reaffirm recession this weekend? I'm guessing not that many.
You know what they've been doing, Tom? They've been pushing it out to next year.
Yeah.
Q1, Q2, back half of 2024. Before we get to Q4, we've got two deadlines to talk about. Government shutdown, deadline looming. That's over the weekend. A little bit later this morning, UAW, Bramo. The good news on that front, if you want to see a deal anytime soon, is that spread, that gap between Detroit's big three, Ford, GM, Stellantis, and UAW is closing. It's closing. The three automakers are somewhere around 20%. UAW were at 40, down to 36, and now we understand here at Bloomberg they're at 30. You'd have to imagine, given that gap at the moment, there's a deal in sight.
Julian Emanuel pointed to that as one of the reasons for the rally yesterday that you saw in stocks and one of the rally that you saw in bonds. This question of how much pricing power, how much maneuvering does labor have in terms of power to get higher wages? And if the UAW is going to go all the way down to 30%, does that indicate a sort of softening in the stance that can really be broader and actually indicate how much wage increases we could see?
So Francisco Linder of the New York Mets, the dreaded New York Mets, that season, good morning, Steve Cohen, season worked out. He did 30-30. So in the strike, are we going to get 30% raise in 30 hours a week? I mean, that's the kind of stupidity.
I'm not sure about the 30 hours a week that's coming, but
could be the 30-30 club.
If it arrives, I'm very much on board. AMH on those two stories in about 10 minutes' time down in Washington. We'll catch up with her on the UAW strike potential a little bit later this morning, the potential for that to broaden, to deepen, and the looming shutdown deadline over the weekend. Here's your price section. Going into the weekend, this Friday morning, equities up higher by 0.5%. Equity futures pushing higher as bonds advance as well and yields drop, at least by 2 or 3 basis points to about 454 on a 10-year.
And we have about 90 minutes before we get a data dump that may be one of the last before the government shutdown. 8:30 a.m. we get U.S. personal income and spending, as well as PCE, that key inflation metric. How much do we see upward revisions to the previous PCE reads? This is what Bloomberg Economics is looking for, even as you do see, as Tom was talking about, the disinflationary push in the actual data for August. 10 a.m. we get the University of Michigan sentiment survey, including the expectations for inflation 5 to 10 years out. In the futures market, you are seeing that kind of inflation over the longer term remain sticky, near 2.5%, not that 2% that the Fed is targeting. There is a lack of belief that the Fed has the conviction to really inflict the pain to get inflation back down to target.
Lisa nails this, folks, when you go out 5 years and then you guesstimate out 5 years from there. And that's an amazing chart, Lisa, where it is simply not turned around.
And we see that with the respect of wages continuing to be pressure, which brings us to that 10 a.m. announcement, Facebook Live announcement, UAW giving some points ahead of that 12 noon deadline for a potential strike expansion.
So excited for you, Mitch, a little bit later this morning. That's like the highlight.
They look. I don't think they can beat Georgia, but I think Michigan looks good. I just
didn't get the call.
I don't think they can.
Is it Georgia, Michigan this weekend?
No.
Okay,
But
I was going to say,
it's
what are you
going to be
talking
like
about?
New Year's Eve, Rose Bowl, whatever.
Oh right,
It's
okay.
championship.
Okay.
I don't think Michigan can get it done against Georgia.
Georgia, great team.
Yeah, every year.
More on our college football analysis a little bit. We won't do that. Mark Haefele joins us now, CIO of UBS Global Wealth Management. Mark, it's been too long. It's great to catch up, sir. Jumps off the page for me, something someone actually likes, energy stocks. Mark, why do you like energy equities right now?
Well, we think that they haven't really seen the earnings catch up with these higher prices. Tom has been on fire all morning. He was just asking a lot of people, does the U.S. have an energy policy? I would say I don't know the answer to that, but it sure looks like Saudi Arabia does. And we think that there can be some persistence in these higher oil prices.
Mark, I look at the persistence in oil prices. I got Saudi out to 102 or well. Why is this time at 100 different than the last time at 100?
Well, I mean, there's a couple of factors in being long the energy names here. One, of course, is geopolitics, and energy stocks can be a little bit of a hedge on a worsening of the crisis. And then, the other thing is the coordination of Saudi Arabia here and pushing, frankly, perhaps on the U.S. a little bit into next year's election, which is also a little bit of a geopolitical hedge. So when you step away from the valuations around the energy names, you also have these geopolitical hedges.
I need to go, just because of time, Mark, I want to go to China as well. UBS has a franchise there back to John Anderson years ago, where you go beneath the cities, you go beyond it, you go deeper into China. Take us where UBS is right now on China domestic economic stability.
Well, I think this is something that me and the team are looking at very closely. We are seeing some signs of consumer confidence just starting to return a little bit. Now, the kind of support for the economy, the stimulus measures probably aren't done, but we're seeing some small signs that selectively we want to be overweight in Chinese equities at this point.
Mark, can you build on that based on your call for oil and the idea that you could be going long Chinese equities? Is this a call for a reacceleration of the global economy that comes in tandem with inflation? Or is this a call of specific geopolitical pressures and idiosyncratic stories when it comes to China that are kind of independent of global growth reaccelerating?
Yeah, I would say it differently. We're looking to build a long-term robust portfolio with some overweights and some underweights. I think when we look at things here, in the U.S., we see inflation cooling, we see the economy slowing, but this idea that anything like a recession, is late 2024 at the earliest. And so in that environment, we think that stocks can do better, and also bonds can do better. I think risk adjusted, we would prefer bonds. Within that equity allocation, that's where we get into some of these selective overweights. I think energy being one, we take note that the emerging markets, of which China is a part, are trading attractively. But I think we would prefer, say, India in a global allocation over China at this point.
When you say you're leaning into bonds, you'd prefer bonds. How overweight are you? How much have you been buying over the past couple of days as we've seen yield go to the highest levels going back to 2007?
I mean, I think this is a time to, we're not trying to be a hero. I think because we see gains on both the bond and the stock side, we're closer to benchmarks in most of the portfolios. But I think that higher grade bonds and, tenor of, say, 5 to 10 years, they should benefit. We should see these yields come down as the growth slows and the inflation comes down. That should overpower some of the things I think we saw this week, which had to do with some of the sales in the channel.
Mark, can we talk about what this bond market move means for specific sectors? And I want to pick out one. I want to talk about the banks. Over the last quarter, we've had a move of more than 70 basis points on a US 10-year. And banks are negative. They're not higher. Mark, can you tell us whether higher rates, high yields help or hurt financials in America?
Well, look, the anecdotal evidence over the past 6 months is that these very rapid moves cause disturbances in the system. So it's not just it's not just levels. I think it's some concern about the rapidity of the moves. Over time, you're going to get different financials able to reprice and the NII at different rates. So I think you have to look through. But one thing I think the past 6 months has shown,
I think we've lost the last line there.
Is that the super elite banks, the ones where the deposit. Sorry, can you still hear me?
It's okay, Mark. Yeah, you dropped out for a second, but you can jump back in, sir. Go for it.
Sorry, I was saying one thing I think we've seen in the past 6 months is that it's the super elite banks versus the smaller banks in the United States, which have those stickier deposits and maybe have the stronger, more durable business models.
Mark, thank you, sir. Sorry about that technical issue. Mark Haefele there of UBS Global Wealth Management. Appreciate it. That last point, Tom, on the financials, difficult moment. High yields has hurt the banks.
This is the number,
over the year so far.
John, it's the number one thing I'm looking at this weekend is a linkage of commercial real estate, tangible assets into the idea of what the banks do when they bring it in short and lend it out long. And it's the heart of the matter. I look at the Keefe Bruyette Index, BKX. It's not pretty technically. I mean, it's just not. Forget about the big guys pontificating. We're going to have a recession. We're not going to have a recession. Bankers are sweating bullets right now.
The stress of spring and struggling to get off the mat for many of these names, Bramo, in the financial sector, and the argument that higher rates help financials. I mean, just look at the screen over the last quarter. That's not been the case at all.
Especially because deal flow has just fallen off a cliff. I mean, companies aren't going to refinance or get mergers and acquisitions together if they do see such volatility.
Paul Juice, Citibank, he's out. He's looking at Nike, and he's got a neutral on Nike. He says Nike is not de-risked. Thanks for listening in Brussels, a small town in Belgium. Tadeo over in Brussels says, shut up, Tom. Farrell's correct. It's Nike.
I'm not saying I'm right. I'm just saying that that's how a lot of people in Europe say it,
Nike.
Which is wrong. Which is wrong. Being here in America, it is Nike, whatever that's worth. Welcome to the program. If you are just tuning in, equities here, positive by 0.5%. Yields a little bit lower by a couple of basis points, 454.86 as we close out the week, as we close out the month, as we close out Q3. We're looking ahead to payrolls next week, Lisa. All of that good stuff to come. We can get our teeth into the data and look ahead to the earnings as well. JP Morgan kicked things off on October 13th.
Maybe we can get our teeth into the data. Let's be clear. This
Possibly.
might actually not come through because of the shutdown that a lot of people say is expected. It's hard to know, though, exactly where the balance of risks is right now. It seems like the market, because it's so evenly balanced, is just incredibly volatile to any surprise one way or another. It's not even as if the market has decided.
Survey, last time around 187,000. My first look at the survey is 170,000. Do those numbers get revised like the GDP numbers just got revised? I don't know.
They get revised, but the trend, I think, sticks, TK, to see jobless claims. The 4-week average, I think it was Neil Dutta over at Renmax said the 4-week average now is at February lows on
Lisa,
jobless
what
claims.
do you think? I mean, October 6th is Jobs Day. I didn't even know that, but what do you think?
Right now, we're seeing the jobs market remain strong. Here's my question is, do you get this disinflation? Yes, we're seeing it, but do you get enough of it to bring the market into this feeling that the Fed really is going to get inflation back down to 2%? Because right now, that conviction has left the building.
We need to talk about two deadlines. UAW a little bit later this morning, shutdown risk in Washington over the weekend. Bloomberg's Anne-Marie down in Washington, D.C. is coming up next. Equity futures positive here by 0.5%. Live from New York City, this is Bloomberg.
multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays. All eyes turn to the U.S. job market.
The jobs report, it beckons.
It looks like companies are just holding on to workers.
What you see is what you get. We're seeing a lot of strength.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
This is exactly what the Fed is looking for.
They now believe you can get back to 2% without damaging the labor market at all.
We might get a bigger whammy than we expected.
The September Jobs Report, Friday on Bloomberg Television and Radio.
He should have been there at the first debate. Look, no one is entitled to the nomination of their party. And frankly, Donald Trump continues to campaign as though he were the incumbent president. But think about this. He's campaigning as an incumbent, but he has less than 50% support of Republicans. That means half of Republicans are looking somewhere else. I think he owes it to our party to step forward and answer the questions.
Former Vice President Mike Pence speaking to Bloomberg's Joe Matthew and Anne-Marie Horden down in Washington, D.C. Balance of Power, 5 p.m. Eastern Time, doing a phenomenal job of catching up with presidential candidates over the last month or so. We'll catch up with Anne-Marie in just a moment. If you are just joining us, a couple of deadlines we're looking ahead to. Shutdown looming in Washington, D.C., that deadline over the weekend. Later on this morning, we have a Facebook Live event for the UAW president ahead of a noon Eastern deadline for the potential of further strikes. Going into all of that, trying to finish this month, this week, this quarter, in a better place. Your equity market on the S&P 500 positive here by 0.5%. Treasuries actually rallying after selling off over the month, over the quarter. We're back to 455.27 on a 10-year Tom. Yields lower by a couple of basis points.
The VIX is 18 level. I'm sorry, I'm old fogey. I go back and look at the VIX, which is a measurement of volatility not of the Dow Jones Industrial Average, but of the Standard & Poor's 500. 18 level, John, into a glorious 16.60 crisis over. Maybe that's what's percolating here, but of course we can't see it.
We said to Julian, if you want to make an equity market call, aren't you essentially making a bond market call? And he said he was.
I think that's brilliant, yeah. And let's review that. He was cautious. We went down to 4,200-ish, and now am I right, Lisa? He's reaffirmed 4,600?
No, 4,450 by year end.
4,450 by year end. Right now, we're going to reaffirm interest in Washington and Detroit as well. Amory Horton is our Bloomberg shutdown correspondent. Let's go to the clock right now. The clock is very, very important. Horton demanded that we have a shutdown clock. It's nice that the government shutdown clock dovetails with Jets, Chiefs, and Taylor. They're about the same time. I mean, it works out as
might be in D.C. this week. New York this weekend, right?
Yeah, they made it. Jets, it's 8:20 Sunday night. Maybe we'll see Taylor get it done pre-shutdown. Amory Horton, we dovetail this morning at 10 a.m. when these two issues cross. What happens at 10 a.m. this morning?
Well, 10 a.m., we're going to hear Sean Fain with that Facebook Live updating union workers about where they stand with negotiations with the big three. And then potentially we will see an expansion if he's unhappy with those negotiations with the auto giants, an expansion of those strikes. And then also at 10 a.m. here in Washington, D.C., Kevin McCarthy will have his news conference, and we'll see an update on where they stand in terms of the government shutdown. We did get the text this morning of the continuing resolution, a stopgap funding measure to keep the government funded after the deadline, which now is less than 48 hours. And included in that is something that potentially he can get his Republican caucus to coalesce around. No Democrat is going to sign up for this. 30% cut in federal spending. Few like defense, homeland security, veteran affairs will not be included in that. And it goes till October 31st. Right. The issue is, even if Kevin McCarthy can pass this, which that's an if, this is dead on arrival in the Senate. So it does look like we're heading to a shutdown.
John and Lisa want to ask sane, normal questions. Anne-Marie, it is absolutely irresponsible to model a 30% reduction in the nominal budget or the inflation-adjusted budget. Who is leading that madness?
Well, this is the far right of the Republican Party. These are the conservatives who are still upset with Kevin McCarthy.
Why can't McCarthy? Why can't the gentleman from Bakersfield just say to them, "Grow up"? No. Why can't he do that?
Tom, I'm sure he has. And if you look in some of the reporting at what happened in the meeting the Republicans had with amongst themselves, there was some pretty interesting words. A frequent Bloomberg viewer, Bloomberg surveillance, Bloomberg balance of power, Representative French Hill apparently said to a Matt Gaetz, which is causing a lot of this. I think we call him the flamethrower, one of our stories. He told him to, explicit word off. There is a lot of frustration in the Republican caucus between moderate Republicans and far-right Republicans. I think you know what I mean, and I'm not going to dignify myself with those words on this program.
I'm hoping we can catch up with French on Monday to ask him about that particular comment. Anne-Marie, is this a choice between...
He's coming on balance of power today.
Well, you can ask him directly. Look forward to that.
Matt Shirley.
Is this a choice, Anne-Marie, between a shutdown or a new speaker? Does it come down to that?
Well, potentially we'll have both. So the Washington Post reporting last night that there's this contingent group on the far right that want to oust Speaker McCarthy. The issue is we have known that they've potentially wanted to do this. It took him 15 rounds to get the gavel. So this has always been lingering over his head throughout negotiations, whether or not it's this current one about fiscal spending and keeping the government open, or it was the prior debt ceiling negotiation he struck with the Senate and the White House. The issue is, can they coalesce around anyone else? You know, the Washington Post is talking about the whip, Tom Emmer. This is an individual that definitely has to hear out the far right of the party. Everyone goes through his door, whether it's to be heard or for him to explain to them what is going on and why they need to get on board. They think potentially they have more of a chance of getting through their conservative agenda with him. But if Speaker McCarthy at the end of the day has to put forward more of a vanilla, clean resolution that we're seeing take place in the Senate, that could potentially mean that you're going to see a motion to vacate. And all of this can happen while the government is shut down. So prepare yourselves for potentially a lot of chaos coming from Washington, D.C. next week.
There's been a lot of discussion about immigration policy, and New York City has been pretty vocal on that as well. There's a lot of disagreement within the Democratic Party. Is there anything on that issue in particular coming to the fore that does speak to an actual policy change down the line that you foresee or that you hear as a bipartisan issue?
Right now, it's not in terms of a bipartisan issue. What you're seeing in terms of what lawmakers are talking about on the Republican side is they're saying, a lot of them, we don't want any more supplemental aid for Ukraine, especially if we don't have enough funding or provisions in asylum seekers in our legislation. So the border has become a huge issue, and what they're trying to do is really put this on the White House, and they're looking to states like New York and talking about the fact that the mayor of New York City, the governor of New York, is asking the White House for help. But right now, those provisions that are in there that the Republicans are talking about do not have Democratic support.
Just quickly, Congressman French Hill, what time, Anne-Marie, later on this afternoon?
Yeah, in the 5 p.m. hour, as long as, of course, he doesn't have to cancel in case he's on the floor taking a critical vote to keep our government open, he is set to come on. And given the fact that his frustrations have now eked out into the public press, this is something we're going to want to talk about.
Absolutely. Some big questions for him later on this afternoon. Anne-Marie, before you go, what was the big takeaway from Vice President Pence in yesterday's interview?
The big takeaway for me is that Pence is really trying to distinguish himself against his former running mate and boss, Donald Trump, when it comes to tariffs. He seems very annoyed about this 10% tariff wall, basically, that the Trump campaign is talking about, that they want to enact. And what you hear from VP Mike Pence is that he says this is going to be a major tax on the middle class. Yes, he was on board for the tariffs with China. He said that his team really says that that was because China is an adversary, but a 10% tariff on everything coming to the United States, he says that is a major killer for the middle class of Americans.
Anne-Marie, thanks for the update. Great work, as always. AMH there. On the latest from Washington, the looming government shutdown. And clearly, Tom, what you're seeing from presidential candidates in the Republican Party trying to draw the former president into some kind of combat, some kind of discussion, debate, and it's just not happening. Well, you saw that come from former Governor Christie, look down the barrel of the camera in the debate and essentially try and get him to come on the stage and join them. And Bramo, I don't see it happening anytime soon.
He's winning by not showing up, so why would he change?
Why would he change? Precisely. I totally agree, Lisa. I mean, why would he change? Tom Emmer, House Whip, legit hockey player, University of Alaska Fairbanks, in a small school in Boston College. The real deal.
Cool. Coming up, Rabita Faruqi of High Frequency Economics. Equities higher. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. we'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Connection lost.
The boundaries of the entertainment world are blurry, and they're all scrambling for the same thing, screen time. And navigating this multiverse is no simple task. At Bloomberg Screen Time, it's culture, business, converged. Bloomberg Screen Time, Naya Studios, Los Angeles, October 11th and 12th. Get your tickets at bloomberglive.com/screentime.
Getting emotional in the commercial break. 2 days of gains on the S&P 500. Is that what Fridays are about? Okay.
No, I don't want celery.
Trying to build on those gains in the equity market. What are you having?
We're Bloody Marys. You know, after this September, we're having Bloody Marys.
Exactly. We're down on the quarter, on the month, on a week. We're up on a session by 0.4% on the S&P. On the Nasdaq, up by 0.5%, trying to erase some of those losses. In the bond market, the move you'd expect, really. Treasuries rallying, equities rallying in tandem at the moment, and vice versa. On a 2-year at the moment, 5.04%. On a 2-year, on a 10-year yield, we're down about a basis point to 456.29. Came so close to 470 in yesterday's session on a 10-year maturity. On a 30-year this morning, 470.23, Tom. Just pulling back a touch there at the long end.
We don't have to talk it now, but what I learned in this September is Mike Wilson cautious, Julian Emmanuel less cautious. Both are participating in the market. I think that, to me, was a major reaffirmation of what we're doing here.
Where you can find
go to
some
cash.
Common ground, TK, is around the energy story.
Yeah.
We heard that from Mark Hafley, UBS, in the last 30 minutes. You heard that as well from
you got to be in the game because you don't know when it's going to go.
Mike Wilson, too. Want to finish on the bond market, potentially here, climbing for a 4th consecutive week on a 10-year yield. In the FX market, you can make it week 11 potentially on the euro. 11 weeks of euro weakness against that dollar strength. This morning, reclaiming briefly 106 and backing away, 105.95, that currency pair there. Firmer by 0.3%. A little bit of yen strength in the mix as well. Dollar yen breaking back down to 149.18. Under surveillance this morning, less than 48 hours away from a possible government shutdown. House Speaker Kevin McCarthy struggling to get hardline Republicans to approve a short-term continuing resolution to avoid a shutdown. White House staff were told to brace for furloughs, and the Treasury said most IRS services would pause. Lisa, we're getting closer, aren't we? 1 day, 16 hours in about 30 minutes' time.
Aren't you excited to keep talking about it until then? I can just hear the enthusiasm in your voice.
I want to get to Monday and not talk about
it.
That's where I want to be Monday.
Well, unfortunately, that's probably not going to happen, and that's what it's looking like because all of these deals don't look like they're actually gaining any traction. The takeaway economically, it depends on how long it goes on. That's what all the notes are saying. So basically, another unknown among the sea of unknowns that are leading to a wide range of potential outcomes.
This is the deadline where maybe we could get some action. We're getting closer at least. Another deadline looming for the UAW strikers, saying the strike against the big 3 automakers will expand at noon unless progress is made. Union President Sean Fain expected to give an update on Facebook Live. It's becoming a bit of a weekly tradition at 10 a.m. Eastern Time. According to our reporting here at Bloomberg, the workers are ready to accept a 30% pay raise, down from the initial 40 at the start of negotiations, getting closer to the something like 20% that's on offer currently. So that spread is closing, Brammer. Unlike the government shutdown talk, I've got no idea how wide that spread is. At least this one is moving in the right direction.
It's a good way to frame it because it does seem like there are changes around the edges. I think Tom nailed it actually earlier when he said we don't know what else is in there. I don't think I would go as far as saying a 30-hour work week, but maybe with respect to certain types of products, mixes of products.
The battery EV thing?
Well, the key issue for the UAW right now is how do they bring in some of those workers, right? How do they actually say to some of the electric vehicle battery manufacturers and some of the workers in the rank and file, it's worth it to come work for us.
Can I ask a dumb question? When do they run out of cars? I mean, I've seen like 4 articles on this, and none of them say like We don't know, is the mystery.
The big question is what cars. So we haven't seen the big strike at, say, an F-150 plant. And Brahma, you get the feeling that that's the one they've got in the back pocket. They really want to escalate things. They'll go after that. Let's see if that happens.
The line in the sand is the F-150.
Right. Based on what we've heard over the last month, I've been looking forward to talking about this story. I've got to try and read this without smiling. Golf's Ryder Cup underway in Italy. Europe making a perfect start as they look to regain the trophy, sweeping the opening morning of matches to go 4-0 over the US for the first time ever, with the US team failing to hold a lead in any of the opening matches. Europe needs to win 10.5 of the remaining 24 matches for victory. The afternoon round just getting underway. Brutal start for America just outside of Rome, Tom, in Italy.
I witnessed this 1999 Brookline, and I believe it was Greg Norman took my breath away with his power. I'm an amateur on this, folks, so let me tell you, I'm not qualified. But my 2-minute takeaway is this really means something to Europe, and it just doesn't float the boat of the American conscience.
Let's park the Greg Norman stuff, because that goes back a little bit further.
Yeah.
1999 Brookline, can you walk us through the atmosphere at 1999
huge
Brookline?
turnout, but it wasn't that Ryder Cup Masters green coat, diplomacy or quietude.
Went out the window.
Majesty out
Went
the window.
out the window.
And then, you come up to the pandemic. I think they were in Wisconsin in 2021, the last time around. And I'm just do the Americans care about this like the Europeans do? I'm asking.
I'm going to ask John a Tom question.
Sure.
In the UK, how do you sort of view golf, right? In Europe,
how do you view
there's
golf?
a view golf in terms of is it the same kind of country club, sort of sense of business meetings go onto the green?
Sure.
Or is it like a more kind of the public courses that people go out and shoot ranges?
Your son goes to St. Andrews to golf camp. That's what happens. That's what happens.
I wasn't cut from that cloth. This is huge in Europe. And I would say this is big in America for the golf world as well. They don't want to lose to the Europeans. Let's be very clear about that. They do not want to lose to the Europeans.
How many people are we going to run into? How many people? You're going to be in aisle 7. I'm going to be in aisle 8 of Whole Foods this weekend. Who's talking Ryder Cup? I think it's just like Masters,
Hold on a second. But that's also New York City. How many people in general are talking about? I'm just saying. It's not necessarily.
You go to Bronxville Country Club this weekend, TK, it'll be on the TVs. They care about this.
Okay.
Right? And if Bronxville Country Club would like to give me a membership, we're here, we can have a conversation. That's the latest. I've got no idea what the end result looks like, but it's certainly a very happy, pleasant start for the Europeans over in Italy this morning.
We're going to reframe here right now off of the festivities yesterday. Some real debate. I thought Mike McKee was really good on the revisions to your gross domestic product and gross domestic income. We recapitulate with Rubila Faruqi, Chief U.S. Economist, High Frequency Economics. She's Senior Vice President, Revision Math. What did you think of the revisions? Do they indicate a slower American economy? And two-part question, and was it a misguess statistically?
Good morning. I mean, when you look at the revisions, they do tell us, there's more of a more in sync in terms of GDI and GDP. There was a lot of speculation that GDP was going to be revised down quite substantially. We're still seeing positive growth. We're still seeing positive momentum in this economy. What has really stood out to us was the downward revision to second quarter spending. All our estimates are based on the strong end to the second quarter, and that's strength extending into the first month of the third quarter. So, we're waiting to see the breakdown, how much of a downward revision we're going to see in the monthly statistics and what that means for the third quarter in terms of growth. I would not be surprised if we actually see downward revisions to those estimates if that trajectory is much slower than we were thinking.
Carl Weinberg 101 is follow the bond market. Nobody in market economics looks at yield like Carl Weinberg and Rubila Faruqi. This yield September that we've had, how do you fold that into your economic analysis?
I mean, a lot of what's happening in the bond market, it really, the higher for longer message, the trajectory of the economy, which was very strong, prior to these revisions. We don't really know what's going to happen. We'll figure that out after 8:30. But, that obviously the supply side of what's happening in the bond market. So all of these things fold into that outlook. What happens from this point on, I think that's really, really important, because if the growth trajectory is much weaker, that has implications for inflation, that has implications for what the Fed is going to do, that has implications for that higher for longer message. Now, we continue to think that the Fed is at a peak. We also continue to think that the Fed is going to be cutting interest rates next year, not because of any impending recession, but because of the fact that we are going to see a more restrictive policy stance as that inflation rate continues to come down. And we continue to see that coming down pretty substantially to a second handle by the second quarter, if not earlier.
There are two pillars of the economy that people are looking at right now as sort of the tea leaves going forward. One is the jobs market, which seems to be pretty strong. And the other is the consumer and consumer spending. And on the margins, you are starting to see weakness there. What are you seeing there that gives you that conviction that the Fed is at a peak and that we're going to see more material weakness?
We've been looking at the job market. We are seeing some slowing from the demand side, some slowing in job growth, some slowing in job openings. This is really about, that pent-up demand for, things like travel, entertainment, things people haven't done in 3 years, right? And we've always, subscribed to the view that that demand is not going to go on forever. So I think we are entering that period where, those demands for the particular services that the Fed is worried about, travel, entertainment, that is going to start slowing down more substantially. People are looking at, a backdrop where job growth is slowing, wage growth is slowing. Yes, real disposable incomes are still rising. Yes, job growth is still positive. But there are things like, student loan repayment resumption. You're looking at diminishing cushion from savings. So those things are going to slow down that path of spending and growth. It's just that we still don't think that means recession. We think it's still positive growth, just at a much slower pace, which will bring down inflation. It'll also give the Fed some room, in terms of what they need to do going further out.
How much is the personal income and spending data that we're going to get in about 50 minutes here? I mean, at a certain point, are these data points so volatile and so one-off that you have to look past it and you have to look at a series of, say, credit card spends much more aggressively than some of the official data?
The data are subject to a lot of revision, but we have nothing better. I mean, I know the high-frequency data on credit card spending. We look at it, it's very important, but, at the end of the day, these are the things that feed into GDP. These are the things that we look at. And, what we're seeing is the revisions, obviously, the annual benchmark revisions, that's really important. That's not something we can really do anything about. But what we're seeing right now is growth is still positive. That consumer and that labor market is something that we are very focused on. Right now, we don't have any signal. Look at jobless claims, look at positive job growth, look at the unemployment rate. We're not really getting any sense that the U.S. economy is, on the verge about to dip into recession or a contraction or a slowdown that would be concerning.
Rabila, thank you. Rabila Faruqi there, High Frequency Economics, looking ahead to some of that data. Sneak peek of payrolls next week, next Friday. The estimates so far in our survey, 170,000. That's the headline number, down from 187. Rabila mentioned unemployment there. The estimate at the moment, things can change. More estimates come in between now and next week. But at the moment, 3.7%, down from 3.8. Tom, a three handle on unemployment, even with the Fed just sitting there, north of 5.
Yeah, we didn't play enough yesterday. I think Lisa nailed it yesterday. Claims, 4-week moving average. You got to be kidding me.
Close to 200K. I know.
Down to 200K. Unreal.
If you are just tuning in, welcome to the program. Your S&P 500 positive here by 0.4%. Yields a little bit lower by a couple of basis points, 455.88 on a US 10-year. Coming up at 8:30, the work the city have done off the economics desk has been absolutely phenomenal, led by Andrew Hollenhorst and Veronica Clark. Veronica's going to catch up with us at 8:30.
Yeah.
Team effort, TK.
I wonder what do they write this weekend along with everybody else? I mean, do you reaffirm a Fed rate increase? How do you do that in this milieu?
They actually just put out a note, so I can tell you kind of what the latest is from their thinking. It does have to do with consumer consumption. And there is this feeling that the drivers of this consumption are broadening, right? We talk about how the economy has been moving on many different cylinders that move at different paces. And right now you are seeing a broadening out, which really does leave the conversation with wages. If people are earning more, and they're earning more on a relative basis than inflation's coming in, that turbocharges some of the spending to create a stickier inflation.
So they're suggesting better consumption?
They're suggesting that the economy is hotter than many people have expected, and that's going to lead to a stronger inflationary pressure and more potential upward moves by the Federal Reserve.
Looking for one more hike in November, alongside Mike Gapen of Bank of America. Matt Miller writes in, on inventory, they have 60 days of inventory on average at these automakers. This is what he said. You're right, thank you, Matt. The F-150 is the line of the sand. I think everyone understands that at the moment, Tom. So the F-150 is the line of the sand. I've got no idea. Based on the progress we've made over the last week, suggested by our reporting, I wonder whether they'd be willing to cross that line of the sand later on this morning. Seems like a significant escalation to take that step. Especially when it wasn't clear whether Ford were on the naughty step or not with UAW at the moment.
It seems like
a guy down the street when I was a kid had an Edsel in the garage. Why can't an Edsel be the line in the sand, or a AMC Javelin?
We're going back.
These are disastrous cars.
The latest on UAW negotiations next.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg. On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
As many of you know, the Fed's ability to influence the economy depends to some extent on influencing the public's view of current and future economic conditions. One of our goals is to influence spending and investment decisions today and in the months ahead. That will only be the case if people understand generally what we're saying and what it means for their own finances.
I have to admit, I'd totally forgotten that Chairman Powell had spoken yesterday, speaking at a town hall with teachers in Washington. I think that speaks to the lack of headlines that we actually got from that address from the Federal Reserve Chair. When he has something new to say, I guess he's going to say it regardless of who he's sitting in front of, and right now he doesn't seem to have anything new to say. Your equity market on the S&P 500 going into the weekend is doing better over the last couple of days. Two-day winning streak, looking to make it 3, up by 0.4% on the S&P. Yields are a little bit lower by a basis point at 4.56, crude a bit higher. We breached 95 briefly yesterday on WTI. We're back down to about 92.79.
Really?
Even with this
American oil hit 95 yesterday.
Briefly.
I did not know.
Briefly. Back down to about 93 at the moment, TK.
Interesting market, interesting Friday, and of course all of us focused on the countdown clock to 10 a.m. this morning, where maybe we'll get an adjustment in Michigan. We got a huge response the last time he was on. Joining us now, Patrick Anderson of Michigan, founder, chief executive officer, Anderson Economic Group, but far more than that, arguably the greatest student of how Detroit became Detroit, what Detroit is now, and maybe the hope and prayer of what Detroit will become. Patrick, thanks so much for joining again. We were talking before the segment here on the chaos of the industry. Like GM can't build a muscle car, so they had to go to Holden of Australia to build the Pontiac G8 because they didn't have the knowledge to do it in Detroit. How chaotic right now are the manufacturing processes of these auto companies who are being very silent within this strike?
They were well running right before the strike. And in fact, what you saw with Detroit was low inventories, as you mentioned. They were highly profitable. The only chaotic portion was the big investment in EVs, where both Ford and General Motors were losing $2 or $3 or $4 billion per year, which works out in some cases to $50,000 a copy for an electric vehicle. That was really the only difficulty going on in Detroit before the strike.
If they are profitable, why can't they give some of that to their valued labor?
They absolutely can. And if you look at the Anderson Economic Group preview of this, we said that these auto workers, like everyone else, were suffering from inflation. They didn't create the inflation. You have to expect that they're going to get wage increases. And in fact, that's what the automakers have offered. The sticking point, and I wouldn't call it just a sticking point because it's more than a point, is that the UAW demands now are for far more than wage increases. They include things that represent actually bankruptcy risk for the automakers, such as a return to the notorious jobs bank and having a defined benefit pension, which were two of the things that led to GM and Chrysler's bankruptcy a decade ago.
In the meantime, what is the ripple effect of what we've seen from the strikes? I know your organization and you've been doing incredible work trying to quantify it. Where are we?
First week cost was $1.6 billion, and those were 1.6 hard numbers, lost, most of which was wages. And a fraction of that was the automakers. A lot of it were UAW, and a lot of it were non-UAW suppliers. The second week estimate, we're going to have that on Monday, but I can tell you it's going to be bigger than $1.6 billion because strikes become more expensive over time, not less expensive. And in particular, what happened in the first week is you can expect some inventory to basically just be sopped up. And pretty much everyone in the industry, dealers, suppliers, manufacturers, anticipated some kind of strike for at least one automaker. So they were ready for a few days. Were they ready for 2 weeks, 3 weeks? Were they ready for Sean Fain? The answer to that is no. They were not ready for the kind of disciplined, focused strategy that the UAW president has brought forward. That's not to say the demands are reasonable, but clearly the leader of this is not the big three, it's the president of the UAW.
They do have inventory still, and so there is a question about whether this will actually lead to higher priced cars. Do you have a sense of how quickly that inventory is coming down? At what point this does raise costs in the near term on auto purchases?
I don't have a question about that anymore. We pointed out before the strike that the inventory in the industry was about a quarter this time what it was in 2019. So inventory is much smaller. And in fact, what you've got is higher prices already. So if anything, prices had moderated a little bit before the strike. And here, the UAW strategy, which is surprising, but again, Sean Fain and the UAW are really leading, setting the terms of this, include hitting parts facilities and strategically picking assembly plants. So they are starting to affect prices. I think this is something to look for in week 3. And one of the things to look is what is going to be announced today. Are we going to stay with the plants that we have, assembly plants? You mentioned earlier the F-150. Right now, Ford's assembly hasn't been hit very much. We estimate that we lost 25,000 production units in the first 10 days, almost all of which were profitable vehicles that would have been sold. So they've lost a lot of production already, and they're going to lose more.
Patrick, we don't have time for a Patrick Anderson 45-minute dissertation on where American auto manufacturing's heading. But in the time we have, we're moving to things that have fewer parts, EV vehicles that are simpler made. On a unit basis, on some form of Anderson productivity basis, does everybody understand there's just going to be fewer warm bodies making these things?
This is a subtext of this particular bargaining session. It's the wild card out there. Until
just recently. It wasn't even mentioned except kind of in hushed tones and in the second or third 10-minute session of an investor call. But a big issue in this is, are we going to continue as taxpayers to subsidize plants that are producing vehicles that require fewer labor hours at wages that are less in plants that are in many cases joint ventures with Chinese companies or South Korean companies or other companies, and actually substitute that for profitable vehicles that consumers want? That's something we outlined before the strike as a serious issue, and that is, at this point, completely unresolved.
Have you got an answer to that? What is your base case at the moment, Patrick? If you just had to take a guess, what would it be?
I don't know what is going to happen, and the fact that President Biden came to the assembly line and said, yeah, well, they should get at least a 40% increase, and then said nothing about whether we were going to continue as taxpayers to subsidize the battery plants and actually pay for the conversion, and that's actually the word that the Department of Energy uses. We pay for conversion of plants that are making vehicles that are now being sold profitably to electric vehicles that are growing, but growing very slowly. There's not a base case out here that works.
And being sold to a high-end consumer as well currently, Patrick, does that complicate the effort?
Absolutely. I've got a battery electric vehicle out in my garage, but fortunately I have another car I can drive. And the fact is that 72%, according to our Anderson Economic Group assessment of these electric vehicles, are luxury cars, which is perfectly fine. But when you have government policy and taxpayer money and contracts and internal subsidies and regulations that are pushing for 40 or 50 or 60% of the vehicles to be those that are primarily favored by wealthier people in metropolitan areas, we have a serious problem both as an industry and as a society. And that is an unresolved issue for which there is no base case for success.
Patrick, it was wonderful to get your insight. Thank you, sir. Patrick Anderson of Anderson Economic Group on some of the tensions out there, Tom, on current policy.
There are huge tensions, and he's one of these think tank guys. He's a claim. He walks around and he's not looking at like the news flow to 10 a.m. He's looking at where are we 10 years out. And John, you've led on this, frankly. And help me, Lisa, just on the chemistry of batteries, not some fancy physics, thermodynamics things. On the chemistry of batteries, are we even in the game versus the Chinese?
To that point, Matt Miller just right again.
What's he doing?
Always turn to internally to get my advice on this particular subject. Yeah. He said the Chinese are hoping we flinch on EV production. Their fingers crossed the union stop U.S. investment in battery production. The Chinese, in many ways, in certain circumstances, leading on this effort. That's the latest on Michigan. A whole lot more a little bit later. Equity futures on the S&P 500 higher from New York City. This is Bloomberg.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
We have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
People ask me all the time, what is the key to being a really good investor? And I tell them, it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
When you go through a period when it's super easy to raise money for any purpose or no purpose, and you go into a period when it's difficult to raise money even for a good purpose, clearly many more companies are going to founder.
It takes a long time for the Fed's actions to work through. Markets are very impatient.
We see slowing quite evident here, but not surprising. But yet we don't see the economy falling off a cliff.
Fed should be able to be cutting rates sometime in 2024. The market's going to feel that out, and when it does, we think equities are going to rip again.
The big risk to me is people just sit in cash and you miss the end of the cycle and the beginning of the next.
What the market is losing sight of maybe is that there is going to be a recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Bloomberg Surveillance, Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television on a Friday to read into the weekend, October, and maybe even read into 2024. We survived the week, a little bit of breath of fresh air, crisis over today, VIX 16.75. But John, globally, the tension's still there.
Just about survived the quarter. Tom, we've got to sit on this quarter. The third quarter in the United States, the Treasury market, yields higher by more than 70 basis points. Tom, that is a monster move. And I'll give one shout out to one guy in particular, Krishna Mamani of Lafayette, who at the start of the year said he thinks the pain trade is higher equities. Halfway through the year, he said he thinks the new pain trade is higher yields. Higher yields and much higher yields has been the story over the last couple of months.
So the pain trader, let's start with equities here. And, you know, the suppleness of Julian Emanuel leading us off today, getting cautious, and now he's getting a little more optimistic as well. But, I mean, Lisa, just plain and simple, are bonds and stocks correlated? Help me.
Well, they have been, but in the wrong way. I mean, they had been diversifiers, right? Now the 60-40 either gets amplified during rallies or duly punished, magnified way on the way down. This is going to be a concern going forward because where do you diversify? And we heard this earlier this week. What if it's the dollar? What if the dollar we saw that emerge as the diversifier in a world where bonds and stocks are trading in tandem?
Yeah, I'll take that. But what I'm going to take is every conversation, whatever anybody's belief is, we're data dependent. John, we got a Seattle slew of data today. We've got wholesale inventories, personal income spending. I guess that's important. PCE deflator, Chairman Powell says that's important. And then we've got Michigan over Georgia, Michigan sentiment. The 5 to 10 year inflation call of University of Michigan.
You Mitch, yeah,
that's a hell of a crystal ball right there.
A little bit later.
Okay.
A little bit later. Jobless claims 200,000. Unemployment still with a 3 handle. This year so far, the recession that never was. The recession that never was. And now we're talking about headwinds for the consumer going into Q4. There's a long list of them. I'll give you 3. Higher rates, higher energy prices, student loan repayments resuming, TK, and there's a whole lot more out there as well. Can we stand up to the latest negative story for 2023?
And yet, correct me, in this hour, Citigroup, and Lisa, you said Citigroup says that there is some form of better consumer out there pushing against what John just said?
There's a broadening out. It's not just being driven by a couple of different sectors. You're actually seeing a reacceleration in certain durable goods or certain just items, physical items rather than services. Here's my question. Take the UAW as a preeminent example in the conversation that we just had. They are feeling the inflationary pressures. They are demanding wage increases along with other things. You are seeing an increasing amount of labor pushback. Does that in and of itself drive an additional consumer push because they do have the additional income coming in from their wages, not from stimulus payments and not from savings?
Okay, so we get beyond, we stagger into October. I haven't figured out what to go as for Halloween, yet. I'll figure that. I think I'm going as Gamma.
Gamma?
I think I'll go as Gamma this year.
What about a barrel of oil, TK?
No, that was a couple years ago.
That was last
Bramo
year's story?
did that. She had the offspring going on the street. One was Brent, one was WT. I'm going as Gamma this year. Okay, we got to stagger through October. I believe there's a Fed meeting out there somewhere. They're all going to wear Halloween costumes at the meeting. What data are they going to have? Jobs, inflation.
Maybe.
Any more?
Can we explain why Lisa's thrown out a maybe? That if you get the government shut down, you don't get the jobs data? Which puts even more emphasis on the earnings that you might get a little bit later in October. So we should maybe look ahead to earnings. JP Morgan, middle of October, Tom. Based on what we heard from Bank of America over the last week, from the CEO and the CFO, who are basically saying no recession, how can you have one when consumer spending is up 4% year over year? That's some pretty strong, powerful pushback from Brian Moynihan and company, Tom, over at Bank of America.
Well, yeah, and it's Brian Moynihan listening to Michael Gapin. This is one of the big things. Moynihan always goes back and cites his economic prism. And one thing I'll say, and this came up a couple times this week, I mean, Lisa, help me here, because we heard it 3-4 times. People are looking at what we're doing with our charge cards, what we're doing with our auto loans. And basically, if it's going up, it's a spike. And if it's going down, it's a cliff, right?
Well, people are borrowing more. And that's one warning sign that people are looking at, is that, yes, they are spending, but credit card outstanding debt is going up significantly. So this is one thing to watch in the soup of uncertainty that we have percolating out of the data factories.
My data to start, John, is a VIX, under 18, under 17, a more benevolent 16.64.
The data factories? What
Come
are
on.
you on about?
Let me get away with that.
You can have that
Give
one.
her some
all
more
right,
money.
all right, whatever. It's almost the weekend. Take a deep breath. Equity futures on the S&P. You're killing me. Up 0.4%. But almost feeling kind if she's saying soup and not brew, right?
It's true.
You know, like the soup of uncertainty instead of the toxic brew.
Toxic brew is bad.
Okay.
Soup is good.
Good, good, good. Equities up by 0.4% on the S&P. Yields a little bit lower by a couple of basis points. Quite a range in the last 24 hours. 468 down to about 455 currently. 455.27 on a 10-year. Quite a range for the euro as well. Had a look at 104. Had a look at 106. It's back down to about 105.96. That currency pair firmer by 0.3%. And crude briefly intraday in yesterday's session, 95 on WTI. WTI right now, TK, 93. We're positive by 1.4%.
We are going to digress right now, and on a Friday, and this is absolutely perfect at the end of Q3. What about the advisors out there? What about the advice you're getting as you recalibrate into the fourth quarter and indeed into 2024? Dana Dioria is co-CIO and group president in EnvestNet Solutions, and they are in the absolute crux of how diversified to be diversified within your financial instruments. Dana, welcome to the show. Thrilled to have you on. Help me here with 60/40. I mean, what are advisors doing as they calibrate 60/40 forward?
I think advisors this year are thrilled about 60/40 because it finally has some yield on the 40. So notwithstanding 100%, we're getting not the nice diversification benefit that we would like in the short run, coming, obviously yields increasing dramatically. And, we of course also experiencing, at least through September, obviously getting a little bit better the last couple of days, but, a tough September for stocks. Right. But that's kind of short run stuff, right? When you're an advisor and the business that you have for these clients, that 60/40 this year with the yield that you're able to get it's still, you know, reflecting back on what we've been through the last several years where there was no we had, they're pretty happy with the 60-40 again as it compares.
You know, I look at what bonds have done, and like an advisor, I've gone to the biggest blended fund, which is the Vanguard Total Market Bond Fund. And I really didn't understand the carnage, folks. If you go back 30 years, and Dana knows is cold, you've got the great moderation, and up you go. And I'm sorry, Dana, we're off a cliff, and BND has just gone through to new lows as well. When do I see bonds get a bid?
Yeah, so I don't know that it's that surprising what's happening in the bond market, right? I mean, if you look at the fact that what the yield curve inversion has been and what we're seeing inflation, you know, as well as the fact that the stock market now for the past year has been pricing in, hey, look, this is going to be a soft landing. We're not looking at recession here. So perk up, right? So, I mean, it's not shocking to me that 10-year yields are finally kind of increasing. And instead, you know, we're seeing that markets now are, which had been doing great, stock markets, excuse me, which have been doing great and pricing in this great growth already, the 10 years now appear to be, you know, catching, are saying, well, maybe it was a little much. So, you know, there's turbulence how these markets come together. But is it really that surprising where 10 years are, given where 2 years are, given, you know, all the economists, the newly minted bulls that we've had in the last few months, even the Fed itself saying, hey, we think we're going to stick the landing. There's no recession here.
Dana, I'm curious about the sentiment in your clients at a time when we've seen a sell-off, at a time where 60-40 has been very punished, heavily punished over the past couple of months. How much are people running versus saying this is a great buying opportunity? Every dip has been buyable. Let's go.
I think, you know, for the most part, advisors on the platform are not super tactical, right? So they're going to look at the allocation of the client and say, okay, what's the long haul, right? They're going to rebalance. I mean, I think the big thing for a lot of advisors is, am I rebalancing back to, you know, the risk tolerance of the client? It's not so much, hey, do I see an opportunity here to take my client assets and, you know, buy in? It's really more about, okay, am I positioning the clients to, you know, for the potential that recession still comes, for the potential that we haven't hit market bottom, or am I letting that allocation get a little bit more equity, a little bit riskier, which will happen, right? In a market where stocks, at least for the first half of the year, were doing phenomenally well and, you know, kind of outpacing. So I think for advisors, it's about saying, what's the overall posture of the client? Am I prepping them well? You know, the advice I give a lot is, look, I'll grant you, there's a lot to be happy about with this economy. We're nowhere near what we thought we would be second half of this year, right? If you talk to people the first half of the year, everybody was like, prepare yourselves. Some of the economists, we get a lot of information from a lot of different places, a lot of asset managers on the platform, a lot of research services. Some of them are just pushing that call out. They're saying, look, it's going to happen. You just, you know, wait for 2024. Some aren't. But what I would say is for the sake of advisors, it's really kind of about, well, am I positioned well in case of a potential problem, right? Because we all know people fear their losses a lot more than they feel their gains.
It's the 3-month rolling recession call of the last 12 months, Dana, hasn't it, TK? It's been a story of the last year. Yeah. It's sort of happening just sort of 3 months out and continuously 3 months out. Dana, thank you for joining us. Dana Dioria there of InvestNet. That bond market, equity market move, Tom, has been painful. Equities down, bonds down. That's been painful.
That is a snapshot into what advisors, well-meaning advisors, are trying to do within diversification, and they're overwhelmed by, wait, why don't we own Apple? I mean, that's the heart of the matter. Should we own Microsoft?
The other heart of the matter, Tom, when you sit down in front of these kind of individuals, they'll tell you 60-40. They'll say you want an allocation to bonds, Lisa. An allocation
60% Apple, 40% Microsoft.
Yeah, and they'll walk you through, Bram, as to why you should do that. And ultimately, it just hasn't worked.
History has broken this year. And I think that how do they readjust, given the fact that there is a new paradigm, at least for now, and it could potentially continue.
If you are just tuning in, welcome to the program. Equities here, trying to do something, trying to bounce over the last couple of days. Adding to that move, the S&P up by 0.5%. Yields coming in a little bit as well. that correlation we've been talking about, it sticks. It's treasuries rally and equities rally, and yields lower by 2 or 3 basis points to 454.65. Veronica Clark of Citi coming up in about 15, 16, 17 minutes. Look out for that conversation as they look for another rate hike from the Federal Reserve in November, and looking out to 2024 for potentially a reacceleration in inflation as well. And on the politics, Mohammed Yunus of Gallup on the looming government shutdown. Always a fantastic guest, Tom, just to gauge where public opinion is lying and where it's shifting to.
Within the arc of Gallup, which goes way past Harry Truman, back decades and decades, it's almost like we're honored to have him on to give us some actual polling substance versus the frenzy.
Well, how is this being received, right? I mean, we talk about whether we're going to get a shutdown, whether we're not going to get a shutdown. We hate talking about it. Everyone hates listening to us talk about it. Everyone's sick of this topic, and yet here we are with 800,000 people who might not be paid starting on Monday. So there's a real question here about how this is going to pull in the general. I believe it's 800,000 government workers that are susceptible to that.
Amazing, but the congressmen, congresswomen still get paid.
Yes, they still get paid.
So does Biden get out there with the megaphone or the flag
debt crisis, I remember making a point, and I wasn't alone to make this, that they should have all been paid in their sovereign debt. And they might have sorted it out a little bit more quickly. The fact they still get paid but can shut down the government is just remarkable to me. From New York, this is Bloomberg.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening, because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
My opinion is we're going to have 10-year rates at least at 5% or higher because of this embedded inflation. This structural inflation is unlike anything. And I think business leaders and politicians are not providing the foundation to help explain this. We have not seen inflation like this in over 30 years.
Brilliant exchange there between Larry Fink, the BlackRock chair and CEO, and Danny Berger. Catch Danny Berger with Manus Cranny. On Bloomberg, The Brief takes place at about 5 a.m. Eastern Time, if you're up early for that one. Equity futures right now on the S&P 500, positive by 0.5%, a lift here in the equity market. Yields a little bit lower by 3 basis points, 10-year, 4.5445 on a 10-year at the moment. The euro's had quite a ride this week, still poised for an 11th week of weakness on the euro against this strong and powerful dollar. 105.97, Tom, on the euro against the US dollar.
Triangulate it. Euro yen is where I've got to go. 158.13 is pretty much stasis. It's been a combined effort. Euro and yen both weak against a resilient dollar.
BOJ move overnight has been quite interesting to see, Tom. Seemingly based on actions alone, based on actions, just a pure observation, seemingly more concerned about that move in yields moving too quickly than they are by levels right now on dollar yen, about 149.
Multiple interventions doesn't work. I mean, am I right that yen's supposed to be 147 now? Oops, it's not.
Well, they're two opposing forces, and that's the problem, isn't it?
Yeah.
Ultimately, if you want to get some support for the currency, you've got to allow yields to come up a little bit more relative to what you're seeing elsewhere.
I think first week in November, it says team surveillance, Tokyo.
Tokyo? I'm not sure the time.
The Imperial Hotel.
The time difference works.
You know, Frank Lloyd Wright's hotel. We can be there in one of the few original parts of the hotel left from the Frank Lloyd Wright era is the bar. So we could, it's a little dark and gloomy. We'd have to. Steve would have to bring in some extra lights. We could do a Japanese thing.
All right. Bramo hasn't mentioned anything, so I'm not sure she's on board for what that's worth.
Broadcasting.
Bramo's very silent. No.
Carry on.
No thanks.
Right, let's carry on. Right now is a really important conversation. And this remembers in my youth, I can remember my grandfather talking about in 1936, oops, FDR won. He beat Alf Landon, and no one except George Gallup nailed that. The tradition continues forward with careful polling of America. Mohammed Yunus, editor-in-chief of Gallup this morning on our distrust of Washington. The 17% reality for you, Mohammed, is our popularity of our vaunted Congress people. It's never been that low, has it?
It's sat around that low before, but we're at rock bottom basically now. 17% of people approve of the job Congress is doing. Those data were being collected really as this shutdown sped up. But, Lisa mentioned history has been broken. Sadly, in this part of our conversation, history is repeating itself. We've had 10 major shutdowns since Reagan, the longest under Clinton, Obama, and Trump. So there's not a lot new here. One of the things people really are expressing in our poll, though, is this question of what is the most important problem facing the country. The most frequent response is poor government and poor leadership. But when you add up all of the issues that Congress is primarily responsible for, it shoots up to 40%. So 40% of people in the country are mentioning a major role of Congress as the most important problem facing us today.
So, Mohammed, how do you put this together? Yes, this is history rhyming, but on another level, if people don't like it, why do they keep voting for the same Congress members?
Well, what's fascinating, Lisa, is people are much more positive on their own Congress representative than they are at the body at large. There is a little bit of a partisanship, 22%, so slightly higher, Democrat. Republicans are at 9% approval of Congress. This just keeps getting worse and worse. When we ask, for example, about the ability, trust and confidence in Congress to solve domestic problems, 56% of Americans say they have no trust in this Congress to do so.
So, Mohammed, how do you understand the accuracy of polls that have been of perhaps spotty reliability in the past number of years? I'm wondering what you glean from this idea, this divergence of overall perception versus the tangible, will you vote for this one person? I mean, are polls getting less accurate in terms of truly measuring who people want and what they really are paying attention to?
I'm so happy you asked this, Lisa. Actually, they're not. It depends on what polls you talk about. A lot of the missed polls or the polls that have been off really have been at the state level. But when you do a responsible representative phone poll, despite the low response rates in this country on national issues and certainly on who do you plan to vote for, they tend to remain very accurate. Tom mentioned our history of forecasting elections. We don't do that anymore, but we still test the methodology of our polls basically by asking those questions. And we find them to continue to be very prescient on where people are voting.
Mohammed, William Jennings Bryan died before the advent of what George Gallup did. And some people would say his movement died with him. Tell us about the Trump movement. Tell us about what Gallup studies about a Republican Party, the GOP of grievance. Does it have legs out years?
Yes, it does. And the grievance far predates Trump. The grievances also trump not just Republicans. One of the really interesting things about President Trump is that early on in his presidential campaign, a lot of Democrats were showing up to his rallies. Many of the things that he speaks to and that people like Bernie Sanders speak to are primarily a popular view in this country, as you saw with the numbers that we just mentioned. Perceptions of corruption are really high in the United States. Trust in national institutions are at an anemic low, and that goes from the Supreme Court to Congress to the FBI, pretty much across the board. So the grievances are there, and they will most likely far outpace President Trump's history and maybe even lifetime.
This now, and I know you don't do the presidential ballet anymore, but now, who is the American silent majority?
That's such a tough question to answer. I think one way I would answer that question is the American silent majority are people who see themselves working far harder in their own lives than their elected leaders are working to solve the problems facing the country. So candidates who speak to those frustrations will have the most powerful messages presented. The other thing that's huge that's happening, Tom, is Republicans are very down on big government, and we see that all over our polls. One of the biggest partisan splits in this country is the perception that federal government has too much power. There's a 51% difference between Democrats and Republicans. So Republicans who speak to that issue will absolutely have a lot more clapping going on for them than those that brush across it and focus on other topics.
Mohammed, you said that polls have been more accurate or the same accuracy as they have been in the past. What do you make of this poll by the ABC News and Washington Post outlets that showed former President Trump up by 9 percentage points in a matchup between him and President Biden?
It's funny you mentioned that poll because it's gotten a lot of criticism. I think even though polls are accurate, it's really important to see all of the data that's out there. So what we do is look at a poll like that, and we look at other polls that use similar methodology. And where a poll is an outlier, that's a serious reason for concern. That poll actually tended to be an outlier compared to a lot of other similarly situated methodology polls that ask that question. So I would take that poll with a grain of salt. And time will tell, but certainly President Trump's staying power is there, whether he's in the debate or not. People are still seeing him as essentially the front runner for the Republican Party.
At the moment, doesn't seem to need to attend the debate at all. Mohammed, thank you. Mohammed Yunus there of Gallup. Always fantastic on some of these issues. Looking ahead on the Open, about 35 minutes from now, Dan Suzuki of Richard Bernstein Advisors, Subhadra Rajapra of SocGen on this bond market, Kate Moore of BlackRock on what on earth to do with equities going into Q4. And a little bit later on this weekend, thank you very much for the tremendous feedback over the last week to the conversation with Daniel Levy, the Tottenham chairman. We'll be playing that out over the weekend. Saturday, Sunday, 1:30 Eastern time.
Saturday 1:30, so, you know, you'll be at Tots Liverpool while the Daniel Levy interview's playing.
Is that right? What time is that game taking place?
It's about dovetails about right. I can't do the time change in my head.
Are we competing with the programming on NBC?
You know,
is that what's happening?
No, yeah, we're competing, but it's a hell of an interview. And, you know, you're so affiliated now with English football. I think Liverpool gave you some tickets in Tots Liverpool this weekend.
What are you suggesting? That I'm going back to the
I'm
UK again this
suggesting that
weekend?
you should do more on English football, is what I'm suggesting. You know.
The effort is gearing up, if that's what you'd like to see.
Well, I'd like to see it.
Okay.
You know, I'd like to.
And some people would like us to talk about it less here, so maybe we can figure that out as well.
Could you figure out if James Madison can play this weekend? Come on.
Great signing this summer, hey? Yeah. Fantastic transfer, so far at least. Future's up. This is Bloomberg.
the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Bloomberg Surveillance, Jonathan Farrow on assignment. Lisa Abramowitz here in Time King. Lisa, a ton of data today.
Yeah, and really important to understand where the consumer is, considering that this is one of the big mysteries. How long can the consumer keep spending at a time where their savings are ostensibly shrinking? They were supposed to go away. They still are here, so, here we are.
Off pandemic, off Fed, now we're restrictive, accommodative, whatever. It's like a pivot point. Is it pivot point October?
Well, and perhaps the PCE deflator, which is one of the key indicators for the Fed, will show some of that good news that people are looking for.
The data wonders out here this morning, a lot of granularity here and important data to gauge GDP. Our Michael McKee, our chief shutdown reporter, joins us now.
We've got more to say about that later, too. All right, let's go right to it. The PCE deflator, month over month, up 0.4. That's double what we saw last month, a 0.2 rise, but less than anticipated. On a year-over-year basis, we're at 3.5%. That's up from 3.3%. The core, though, only up 0.1%. Half of what was seen in July. Now, remember, these are August numbers. We're also getting, and I'll get back to this in just a second, we're getting revisions because yesterday they revised GDP, so that affects these PCE numbers. The core deflator, as I said, up 0.1%. On a year-over-year basis, up 3.9%. The prior month was revised up to 4.3%. And so it's a bigger drop, even though the prior month was revised up. So at this point, some progress from the Fed. The headline number, 3.4% in July, down to or up to 3.5% rather in August. Other numbers out just now. The trade balance, $84.3 billion. That is down from 90.9. That will add to third quarter growth somewhat. Inventories down 0.1%. They had been down at 0.2% in July, and retail inventories up 1.1% after 0.5%. So all those numbers there will be something that get factored into a maybe higher GDP number.
The market move in that observation while Mike dives further into this data. The market likes what it sees. Futures up 28, Dow futures up 186. The VIX comes in a stick right now, 16.3 at 1. In the yield space, a 10-year yield comes in now 4 basis points, 4.54%. Lisa, while Mark was warbling gaily, I did a log triangulation of the last 10 days of the 10-year yield, and the critical point is 4.51%. Lisa, we're not there yet, 4.55%.
I'm glad you go to the technical aspect of this, because this feels like technical moves on the periphery of data that doesn't really offer us really conclusive kinds of messages. Right now, what I see that stands out to me is that this is your soft landing, beautiful scenario where basically consumers are still spending, albeit on a slower pace, and you are seeing on the margins disinflation, albeit also not at that fast of a pace. Is this enough to get the Fed back down to 2%? The market on the margins is feeling a little more comfortable.
The 10-year real yield, 2.17%, and again, 3 standard deviations of the bond turmoil in yield that we've seen is a 4.50%, really almost out to 4 decimal points. So we're not there, but we've broken down nicely under 2 standard deviations to a lower yield. Mike, 2 more observations. Go.
Well, spending and incomes are both up 0.4 for the month. As we noted, the spending numbers down from a 0.9 gain in July, so cooled off a little bit. That would take something away maybe from GDP. But according to the government, it's mostly spending on gasoline. Is the biggest category as gas prices went up. The biggest category for the current personal income rise is compensation. So people making more money than they had been making, which you'd see as a good thing. Personal savings rate comes in at 3.9%, which is down a little bit from the prior month, but it fits into the narration of do we see people trying to, at this point, spend their savings to keep up their spending.
Yeah, that's a
Just
low
quickly,
number.
we're looking right now at these data points that are going to have to be included in a series that then are mapped out over time so the Fed can come to some sort of projection. Are we going to get the next point in the series? Are we going to get that jobs report?
Well, the jobs, we will find out probably today. As a matter of just practical timing, it looks like something will have to shut down on Monday because they can't just legislatively get things through Congress, even if they made an agreement today. And if so, it takes a couple days to get everybody back to work and get back on track. So it's not clear about whether next Friday we would get the jobs report or not. Obviously, if we go into the beginning of next week, past Monday, you would not get the jobs report. The more worrisome thing is, would you not get the CPI and PCE reports because the Fed is very concerned
And when
about.
are they? They're like a week later, right?
The CPI, I believe, is the 14th, maybe, and PCE comes out the 27th of September.
Quickly here, next Friday, you fly, you take your junket down to Washington, you go to the Bureau of Labor, and there's no one there?
Yeah, we'll have pictures of me knocking on the door. No,
that's a reality.
There will be people working there, but not the people who release the data, and all of them are not getting paid. We should mention, too, that if this shutdown goes into next week, Fat Bear Week will not take place. The government, the park rangers up in Alaska can't run the Fat Bear cams.
The Grizz cams, bear cams.
It's Fat Bear Week where you get to vote on the fattest bear. As they get ready for hibernation, and this is a huge deal on the internet. So.
We'll have to look that up. Michael McKee with news you can use from Alaska. Thank you so much, our chief shutdown correspondent. They have led the way to this higher rate regime that we are living. Veronica Clark with Andrew Hollenhorst leads from Citigroup. What are you writing this weekend, Veronica? Cut to the chase. We need a surveillance out front look. What are you going to publish for Monday?
Yeah, I mean, we've had a lot of data. Of course, this week we had GDP revisions yesterday, all the spending and inflation data today. Overall, it doesn't really change the picture that much. I mean, growth seems pretty resilient. Yeah, we've had some slowing in inflation, but we did get revisions higher. We're coming from a higher rate. There's really not that much to change a pretty solid growth backdrop, inflation that's still high, really not much to change the message from the Fed, which we heard last Wednesday is higher for longer. And so I think that's the outlook.
Veronica, when you take a look at credit card spending, a number of people are saying anecdotally you are seeing a significant decrease in activity, that people are being a little bit more frugal and a little bit more discretionary with their income. How much do you reject that in your thesis that you're seeing almost a reacceleration in certain areas that could fuel inflation?
Yeah, we've absolutely seen that in goods spending. A lot of the story of the last couple of years has been, people were shifting spending away from goods and back towards services, as things were reopening. But the last couple of months, we've absolutely seen retail sales spending, that's on goods tick up. We've seen strong durable goods orders. So it's not, entirely that people are shifting their, slowing spending. It's maybe that, things are shifting relative to the patterns of the last year. Growth is not just supported by services consumption anymore. It's really, much more broad than that. It's goods spending, it's investment, and those types of components.
So if you take a step back, you listen to all these people saying that consumers are slowing, but not that much, and that you are seeing the economy slow, but not that much, and you're going to get this disinflation that's going to lead to a perfect soft landing. What's your main pushback about why inflation is going to remain sticky and why this is going to become a persistent problem that the Fed's going to have to address more aggressively?
Yeah, absolutely. I mean, it really does come down to, when we're doing inflation forecasts, we're looking at the different components and the drivers of it, and a lot of different, components like what I mentioned in goods, those, prices are kind of ticking up again. That's been a lot of the disinflation of the last year, from supply chains correcting and commodity prices falling. Well, those stories have kind of reached an end and commodity prices are rising again. And, if we look at the current disinflation, what we expect to see in the next couple months, a lot of that will come from components like shelter inflation. And that's just reflecting that, home prices fell in 2022, rents have slowed, but the last 4 months of home price data, we've seen those prices rising again. So there's a lot of reasons to believe that, if we're not slowing enough, if we're not, in a scenario that looks like a recession, well, then you just get some inflation coming right back and you're just stably at something like 3 to 4%.
When you talk about market action and at what point the Fed is actually transmitting their policy through the long end of the yield curve, Veronica, how much has the yield move higher that we've seen to the highest levels going back to 2007 created a greater pressure that could actually knock inflation down more versus actually being sustainable and something that we see over a longer period of time?
Yeah, I mean, the moves, of course, in longer end yields that we've had in the last couple of weeks are tightening financial conditions. That will help slow things down. We do still have a recession in our base case for next year, because of this, tightening of financial conditions. And yeah, the transmission of higher rates really didn't, flow through with the normal, 4 to 6 quarter lag that we were expecting. And maybe that's because, corporations have termed out their debts. People are just not, as sensitive to high rates. But that doesn't mean that they won't be as those kinds of factors fade. So I think you can still expect some slowing at some point from higher rates. But the Fed's own forecast, kind of incorporated that higher for longer narrative, but you really didn't see it in their growth forecast. The Fed is still very much on this ideal soft landing kind of path.
To be clear, Veronica, which measurement of disinflation do you and Andrew use? Are you wedded like I am to 3-month annualized because it was beaten into me as a young child, or do you use another measurement here of the gradient of disinflation?
Yeah, I think something like a 3-month annualized is a good way to look at the current trend. Obviously there's been a lot of focus the last year or so on the core non-shelter services. Those are the services like recreation or transportation, that are tied really to tight labor markets and strong wage growth. So we look at all of those measures. But in the end, the most important measure is the one that the Fed will be targeting, and that's total PCE inflation, and of course they'll look at core inflation, and all of those components do matter. The path for goods prices or shelter, it all does matter. It all is measuring what people are spending.
Veronica, thank you so much. Veronica Clark with Citigroup this morning, and here with the 10-year yield really on the cusp of a 4.53 and 4 basis points. Just sigh of relief on a Friday after what a week.
Yeah, but a sigh of relief to what level? I mean, if you had said a sigh of relief to 4.55% on a 10-year Treasury yield, a week ago, people would say that's not much of a sigh of relief, Tom.
Well, it's good. We're going to have to see here as well. Let's do a data check. We advance up, up 1% on the NASDAQ 100, 15,000 level. Wow. On NASDAQ 100. On the Standard & Poor's 500, up 31 points. We are up 0.7%. Lisa?
We are looking right now at fairly muted reactions to this data. But what I find interesting is that U.S. core PCE prices posted the smallest monthly rise since late 2020. So those in the disinflation camp, this might be a breath of fresh air, a little bit of good news, which is maybe why you're seeing a bit of bid to the tape in this sort of sigh of relief that you talk about on this Friday after a pretty tough week.
That's good. It's been a pretty tough week, but again, into the data dependency. And of course, the importance here of 10 a.m. Stay with Bloomberg News, radio and television here. I mean, Lisa, it's 8:42. In an hour and 15 minutes, the world changes. We hear the Speaker of the House, and we hear, am I correct, UAW on Facebook?
10 a.m.
All
Facebook
at the same
Live.
time. Two separate stories.
Two separate stories, but related to the angst that we're at right now, both the political wrangling, but also whether people are going to demand more at a time when inflation is challenging what they can spend. That said, I do think it's interesting when you take a look at some of the granularity of the data that real personal spending surprised to the upside. So what I find interesting is despite what you're seeing with perhaps for a couple of years, inflation outpacing wage increases, you're still seeing people spend.
Right.
Savings were supposed to be out. People are still spending, and that continues.
Well, the quiet there's there, and I go back. It's like a broken record, folks. I'm sorry. The 10-year real yield 2.16%, certainly pulling back from the shock of what we saw on Wednesday as well. Matt Miller really helping us out with the auto story today. He emails in and says, Tom, Bitcoin, quote it. 27,000, 26,994 on BitDog. We only do that for Matthew Miller.
That really helps with the auto story.
Really helps
with
the auto
You're
story.
going to pay for your EV
Crypto,
with Bitcoin?
It's going to be interesting to see. The VIX down over a stick. That gives me a good market. S&P futures up 31. This is Bloomberg Surveillance.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
The boundaries of the entertainment world are blurring, and they're all scrambling for the same thing, screen time. And navigating this multiverse is no simple task. At Bloomberg Screen Time, it's culture, business, converged. Bloomberg Screen Time, Naya Studios, Los Angeles, October 11th and 12th. Get your tickets at bloomberglive.com/screentime.
Fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
We're at very low supplies. There's going to be a tremendous strain on the market, already is. We're seeing it now in the front end of the curve, a tremendous amount of premium called backwardation. Today's prices greater than next month's prices. It's a clear signal that the market is undersupplied. There's too much demand. And again, we'll need prices to go even higher here to even out and bring this market back into equilibrium.
The inelasticity of the oil market. Stephen Shork, principal of the Shork Group, really interesting on that dynamic earlier this morning. One thing that I'm watching, Tom, this morning is just some of the consumer discretionary stocks after a real tumultuous, I'll get it out, quarter. Where you get this sense that this is the area that's been most beaten up. Oh, wait, maybe not. Nike shares up more than 10% after reporting that they've been really working down some of their inventories. And you can see the commensurate move in Dick's Sporting Goods and Under Armour. Those shares up more than 2%, both just the knock-on effects of clearing inventory and suddenly getting back control over pricing power. And Tom, I do wonder, when you take a step back, whether you are starting to see on the margins consumer discretionary clearing out some of the angst and then able to pass along some of the higher prices more aggressively to consumers. It really speaks to a different moment than this sort of like soft landing, this feeling that we're seeing a real kind of weakness in the economy.
My head's spinning. I want to talk to Michelle Meyer at MasterCard. I want to see what the charge cards are really speaking right now. We'll have to see on that. A busy morning here. Futures up 29, Dow futures up 200. We're up a stick. Yeah, up a stick on the NASDAQ right now, 15,000. On luxury, Oliver Chen joins, senior equity research analyst, Cowen, also a study on the faculty, I should say, Columbia Business School this morning. Okay, I'm going to do a pitch-in at the Sunset Tower in London. I'm wearing my Hermes. I'm wearing this. I'm wearing my Dior. And I'm going, guys, it works. Breakfast at Costco. It just is not as romantic as breakfast at Tiffany's. Is luxury dead?
Luxury is not dead. It's a very resilient industry. And even at Costco, which has a higher household income, you can get great diamonds, great fine wine. But what's happening is consumers are looking for retailers with very low prices and retailers that can charge a lot. So luxury and value continue to work. And the consumer spending, Lisa, 3.8% unemployment, money on the sidelines. There's plenty of spending power, rapid shifts. What is good is inventories are in better position. So Costco inventories are running negative. It's putting them in a great place. That's happening across the sector, and we'll see easier compares.
Oliver, it happens in the news business. A death in Washington. We're going to have to go to that. Oliver Chen, we deserve to have a long conversation with you in a bit. She was the mayor of San Francisco for 10 years, and no one expected 30 years plus in the United States Senate. Dianne Feinstein of California, always of San Francisco, has died. An important moment here. It has been a story for 2023 as she provided Democratic Party leadership for over 30 years in Washington. Our Anne-Marie Horton provides perspective now. Anne-Marie, your thoughts on the passing of Dianne Feinstein?
Well, Tom, it's a very sad day for individuals in Washington getting this news, and NBC reporting this, and Punchbowl News reporting this. She was an absolute trailblazer, one of two of the first women to ever be elected to the Senate, and she was the longest-serving woman in the Senate. And there's a number of accolades we can talk about her, Tom, whether it's not the fact that she really was driving home legislation, whether it was about gun control laws in the 90s or gay rights and for the LGBTQ community. This is going to be a sad day for everyone in Washington, not just the Democratic Party, but also Republicans as well.
Anne-Marie, was this expected? I mean, not just because of her age, but just in general because of deteriorating health?
Well, she's 90 years old. We do know that she had a bout with shingles, and then she came back to Congress. And when you see her, she has been wheeled around in the halls of Congress in a wheelchair. So it's been a very sad state of affairs for the senator, and a lot of attention has been put on her just because of her age. And there was, of course, a moment over the summer when she was told how to vote. She seemed confused, and she was told just vote A on this. So that's why she's been a big focus over this summer. But obviously, she was still showing up to work every day with a lot of help and care, but she was still working as a senator from California. But she was 90 years old and had a very difficult health situation she was dealing with.
Anne-Marie, when you talk about her legacy and you talked about all of the different generations that she really led through, what is the ultimate legacy that she's going to leave behind? And really, who takes the helm from California to pick up where she left off?
Well, it's going to be some big shoes to fill when you've given all of the glass ceilings that Senator Feinstein continuously broke, not just being the first female mayor of San Francisco, but she was the first female to lead the Judiciary Committee. This is an individual who was a trailblazer for women, but also key legislation, as I mentioned, especially when it came to gay rights and the LGBTQ community, as well as when you talk about gun control legislation. Right. These were things she was very passionate about. California Governor Gavin Newsom said he would make an interim choice if Feinstein wanted to vacate her seat. There was discussions of whether or not she was going to come back to the Senate when she was dealing with these health concerns, and that's what he said. And I imagine that's what you would expect from the governor of California at some point. Obviously, people will potentially, there'll be whispers of that talk today, but I think everyone today is going to want to make sure that they are doing justice to the legacy of this individual.
There's no question the focus today will be on Senator Feinstein, but Anne-Marie, George Skelton in the Los Angeles Times, with grace and dignity, speaks of what the governor of California has to do. And there's a legacy here with Abraham Lincoln. There's a legacy here with, I believe it was FDR, and that President Biden would suggest to the governor that the vice president would be an appropriate new senator for California. I mean, not today, I agree, but in the coming days, that's got to be topic one, right?
Well, I think there's a lot of individuals who potentially would like to see that, actually, and potentially to see Biden maybe look elsewhere for a running mate for the upcoming election. Obviously, that is rumors and speculation, and that is something I cannot speak to with facts, especially at this moment.
At this moment, Anne-Marie, what I find fascinating here is a set of conservatives had an immense respect for Dianne Feinstein's permanent liberal trajectory. It was remarkable to me how the conservatives respected the month after month effort she made for liberal politics. Who are those people on Capitol Hill? I mean, how will Senator McConnell respond to this passing?
I think Senator McConnell will come out with a heartfelt message about Senator Feinstein. I mean, even though these individuals don't agree all the times when it comes to policy, Feinstein was also known to want to work in a bipartisan manner, and she has. And I think she is greatly respected on the right, even if you did not agree with some of the policies that she wanted to enact in Congress. But this is someone who definitely wanted to work with, almost feels like in another time of how our politics work.
Well
someone
said.
who really did reach across the aisle.
Yeah, this is just really important, folks, from In Another Time, a topic for Balance of Power this evening. Anne-Marie Horton, and look for Joe Matthew as well, Balance of Power here. Dianne Feinstein dead at 90. We are here on a Friday, and we're going to say to Oliver Chen of Cowen, boy, you need to come back. And we're sorry that we had to interrupt that important conversation for this news from Washington. Lisa, I don't know, is it like Short Squeeze Friday? Is that what we're calling this?
Well, as we move from the news that we will be following throughout the day of the legacy of the longest-serving Congresswoman, we are also looking at a rally that is trying to make up for some of the losses, some of the carnage over the past quarter. It really has been a difficult one. The most interesting aspect to me is that, yet again, bonds and stocks are moving in tandem. So we're not moving away from that correlated world that's giving some people angst. This feels like it is a move in tandem as the market resets.
Disinversion in place at real yield, which we've completely lost perspective on, the 10-year real yield, 2.16%. I should note Brent crude into the weekend, $96 a barrel. We'll be watching a gallon of gas here through October and into, frankly, into 2024. Dollar dynamics, dollar fractionally stronger off the large set of economic data that Michael McKee gave us. The yen in the news here. Look for our conversation on the yen Sunday evening, New York time, as they open there. We leave you with a senator from California, always from San Francisco, Dianne Feinstein.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
In the middle of a massive exhibition center located on the western suburbs of Shanghai, where the annual car show is taking place. This is the first exhibition after the end of the COVID lockdown. We can feel a lot of excitement on the ground. Electric vehicle is going to be the new theme of the industry. Most of the European companies and Japanese car makers who are considered latecomers to the China EV party are, launching their EV products. They are making their foray, intensifying competition in the market. For example, Volkswagen yesterday debuting their ID.7, which is electric vehicle rivaling the likes of Model 3, which is one of the best-selling products in China. And Mercedes-Benz, they are announcing the launch of their new super luxury model of Maybach, which is going to be a fully fledged electric vehicle priced at $200,000 each. Domestic players are also trying to maintain their lead in the market. BYD, for instance, unveiled its first luxury model called Yangwang yesterday. It's priced at about 1 million yuan. At the same time, it's seeking to gain market share in the mass market as well. Needless to say, attracting all the car makers to the Chinese market is the rosy growth prospect. Demand is surging. By some estimates, EV sales in China are on track to exceed 8 million units this year from more than 5 million last year. The future of the car industry is EV, for sure, no question about it. This is Charlie Zhu, Bloomberg News, reporting from Shanghai Auto Show. Bloomberg News, reporting from Shanghai Auto Show.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
Let's get you to the weekend. Let's wrap up this month, this quarter, this week. Live from New York City this morning. Good morning, good morning. Your equity market positive by 0.7%, trying to end this quarter on a high. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, looking to end a difficult month on a high, the government inching towards a shutdown, and Detroit automakers bracing for more strikes. We begin with the big issue, a third quarter to forget.
Coming into the end of the month and a quarter,
this environment has been so difficult.
Has been choppy, has been challenging.
Negative momentum in the bond market.
You've seen consumer discretionary stocks coming off a bit.
Higher oil prices.
Inflation actually gets tailwinds right now between wages and oil prices and a host of other factors.
You're still in this fuzzy period of time here where it's unclear if it's just a give back from the strong summer months.
As we look to fourth quarter in 2024.
The fourth quarter's got these weird things.
Whether it's the strike, whether it's the shutdown.
Student loans restarting.
The market is likely on better footing in the fourth quarter.
You should be starting to see an inflection point in earnings after 3 quarters of negative earnings growth.
Earnings are going to continue to grow.
We're circling this earnings season as a critical one.
The risk for the fourth quarter is, can the consumer continue to surprise on the upside?
There's still challenges ahead.
Joining us now to discuss is SocGen, Subhadra Japa, Dan Suzuki of RB Advisors. To the both of you, thanks for being with us to wrap up the week, the month, the quarter, and get ahead to October and Q4. Subhadra, can we have any confidence that yields are going to fall when we have very little confidence as to why they're higher?
That's a very good question, given the fact that we've seen this sort of precipitous rise in yields in a very short amount of time. It's really hard to know where we go from here. I wouldn't be surprised if we head towards 5% because of the momentum, or we start heading lower if the data actually surprises to the downside. So to me, the risks to yields are somewhat symmetric at these levels. But what I'd be looking to see from here on is the data. We get inflation data as well as employment data before the next FOMC meetings, and we'll be looking to see what the reaction is in the market to the shutdown. Typically, the bonds tend to rally in a shutdown, but really we've also seen a little bit of a buyer's strike. So we'll have to see if investors are willing to step in and buy bonds at a time when you have this momentum going the other way, pushing yields meaningfully higher.
What a month in September so far. 2-year up something like 20 basis points, but all the price action really has been at the long end. On the 10-year up by more than 40 basis points for the month. On the quarter up by something like 70. Dan Suzuki, from your perspective, what is the dominant force underpinning this move we've seen develop through 3Q?
Well, I think, Jonathan, ultimately, it mostly comes down to growth. I think there's a little bit of supply-demand dynamics going on with treasuries and the significant amount of issuance and less buyers. But I think ultimately, you've had a much more resilient growth environment. People have had to take up their expectations for growth, Fed policy, and that's been the biggest driver of higher interest rates. Now, I think that it's no surprise that that's come at a time where, markets are actually have been selling off a little bit to price in sort of that higher liquidity, higher interest rate, or tighter liquidity, higher interest rate environment. So I think there was a narrative that was, kind of overtook the markets of a Goldilocks scenario of resilient growth and lower inflation. Now, I think a lot of that story is somewhat intact, but I think just people are starting to price in the risk to that story.
Fed President Goolsbee thinks it's intact. He said this: the unwinding of supply shocks, the composition of demand returning to more stable patterns, Fed credibility, central to why he thinks it might be possible today to reduce inflation while avoiding a deep recession. Is that your base case still, Dan?
No, it's, I don't think it is a sustained base case. I mean, I think, the way I think about it is that there's risks on both sides, and I don't think the market was really focused on those risks. I mean, in a better growth scenario, you're going to get higher inflation, and you're going to get a Fed response to that higher inflation. I think that's just where we are. I think economically, we are late cycle. In a profit cycle perspective, we are early cycle. But from an economic perspective, we're at that point where better growth means higher inflation and a tighter Fed. Conversely, if growth at some point starts to slow because of tightening liquidity, tightening credit, then that's another risk that's not being priced into markets. And I think, the shift has been toward the positive growth scenario, and that's why we've had to factor in, the impact of the risks that comes with.
Well, let's discuss the balance of those risks, so to speak. Subhadra, you mentioned those risks are more balanced. Through the summer, we were talking, and you would say risk to yields are skewed asymmetrically to the downside. What has brought them into balance for you?
It's the fact that we are seeing investors start to push back on taking down Treasury supply. You are seeing, the tailed auctions. You've seen a really tremendous rise in term premia. Term premia has gone up by over 100 basis points. That's even more than what 10-year yields have sold off in the last month. So the dynamics in the bond market are definitely changing and not necessarily favorable from a demand perspective. So that's kind of what I think has changed. Again, the data has been very supportive. We've been getting okay data. You really need to see the data turn, lower meaningfully in the fourth quarter. I mean, consumer could come under pressure, which is our expectation. Student loan moratoriums end, which is going to, impact the consumer. Savings rates are being depleted. So those are the dynamics that I think ultimately could bring investors back to the safety of bonds. Also, I think if yields remain persistently high, borrowing costs for the consumer are going to go up quite meaningfully. You're looking at mortgage rates, continuing to go up. Corporate bonds as well are going to come under pressure if corporations are going to have to refinance at much higher yield levels.
Subhadra, you mentioned rising term premium. Steve Major over at HSBC wrote this week, that rising term premium is occurring because investors are being asked to receive bonds for less yield than offered in the money market, and at a time when budget deficits are increasing without a recession. Can we just dig into that a little bit more? Subhadra, that discomfort we have with financing the deficit in an expansion, will we find comfort financing it in a contraction? Do we need bad data for this to turn around?
This is a very different time than in the past. You're absolutely right in pointing out that the yields in the very front end are very attractive. So you probably want to stay in shorter duration assets because on a duration adjusted basis, you get much better returns. But then, over the long end, typically the 10-year yield tends to trade in line with fundamentals. You are seeing some technicals that are pushing 10-year yields higher, but if you're looking towards a growth trajectory that's going to be anywhere between 1% to 2% for the next several years, we're calling for a recession in the U.S. by the middle of next year. Under the circumstances, you should start seeing the 10-year yield trade much more in line with fundamentals. And that would mean that yields will have to decline. Just that right now, as it stands, you're seeing that the demand dynamics and the supply-demand dynamics are not favorable for 10-year treasuries.
The yield to decline this morning, just a touch. We're down about 4 basis points on the 10-year, 4.53 at the moment. On the 2-year, just north of 5%. Plenty of economic data through the week. Looking ahead to payrolls next week as well. Let's get to Mike McKee. Morning, Mike.
Morning, John. Well, it was a very interesting morning in terms of data because we got some contradictory data, at least the past that we were on. We see income and spending come in opposite directions. Income's up 4%, a lot of that wages, while spending also at 0.4%. But that means that income has gone up while spending has gone down, and that's not the story that we have been told. And we were told everybody was spending off of their savings account. You can see the yellow line there. Personal savings went down. And so it kind of confusing as to what direction the consumer is going to go. We were talking about this yesterday, and it's going to be interesting to follow. Now, the other thing that is of great interest to the Fed and everybody on Wall Street is, well, I'm calling this the end of inflation because we may not get any more numbers coming up soon, but headline inflation comes in at PCE level 3.4%, while the core at 4.3%. The headline is up from the previous month. The core is down from the previous month. And then when you look at the core, super core, and the PCE numbers on a month-over-month basis, you see something very interesting. We're seeing a continuing decline in the core, which is what the Fed wants to see. I'm not sure the super core updated exactly right here, but basically what happened with super core is it came in up 0.1%. And here's what analysts are saying. Omar Sharif at Inflation Insight says, if we continue to see something like that, then the Fed is going to be way over in its fourth quarter PCE inflation estimate. We're going to see 3.3% for the end of the year instead of 3.7%. You'd need 0.3 gain every month in order to see the Fed be correct. So that weighs into what people are thinking about what the Fed is going to do, and we're down to a 16% chance of a move on November 1st. And of course, one of the problems is the government shutdown. We're not going to have a lot of data. A lot of the data that we are expecting is going to be off the charts. If that does not happen, September jobs on a Friday, but there's 2 inflation indexes, and then I had to mention
Fat Bear Week. What is that?
Fat Bear. Every week, the Park Service up in Alaska, they have bear cams, and they take pictures of the bears, and the bears are all feeding to get as fat as they can before they get into hibernation. And so the American public can look at this website and you vote on who you think the fattest bear is.
Nice. Okay.
And they're not going to be able to do that because the law would prohibit them from updating the internet.
Right.
If we're out of work. And I think that's the breaking point for the American people.
Not the millions of people that might not get paid, Mike. It's Fat Bear.
It's Fat Bear.
Even the cameraman's struggling to keep it together. Mike McKee, thank you, sir. Inflation and disinflationary trends. Dan Suzuki, if you can help me get out of this hole, I'd appreciate it. Things headed in the right direction. It's happening even with the labour market looking pretty tight. Your line reads as follows. Corporate profits are bottoming. Things are going to get better by cyclicals. Dan, why is that?
Well, I think, part of this is just, you create a lower base off which to grow. It's easier to grow. So, there's been I think what a lot of people don't realize right now is there's been a decoupling of the economy, parts of the economy, and the economy with profits. I mean, we basically had this decoupling of goods and services since the pandemic, and that's still with us. So, you've had this, services boom, the good side of the economy, whether it's manufacturing, goods, shipping, corporate profits, all that stuff has been in recession. Now, that's persisted, and all the indicators suggest that that's actually starting to improve, whether it's industrial momentum, PMIs, even the labor market's showing signs of life in jobless claims. So I think that in that environment, you're going to see corporate profits improve off of these, depressed levels, and that's going to support, cyclical assets. Now, whether that translates into a better economy remains to be seen if that decoupling, persists. You could have an environment where, this services economy continues to gradually weaken at the same time, profits improve. I mean, that's been par for the course for the last few years.
So, Dan, when you say cyclicals, what do you mean precisely? Energy, banks, where are you looking?
Yeah, I mean, if you look at the broad sectors, I mean, to me, there's cheap cyclicals and expensive cyclicals. Obviously, a lot of people don't even consider technology-related names to be cyclical, but they are. That's an expensive source of cyclicality. So I think, the type of cyclicality that I think is most attractive here is traditional cyclicality. Now, both will benefit, but one trades at like a fraction of the multiple of the other. So I think you can get better growth, better earnings growth at cheaper valuations. I mean, to me, that's a no-brainer.
Dan Suzuki, alongside Subhadra Rajappa, sticking with us going into the opening bell about 17 minutes away. Equities near session highs here, up by 0.7% on the S&P. With some movers, here's Abby.
And John, we're looking at the best 2 days since August 30th. And if you recall, the rally at the end of August prevented the worst month of the year. Let's see if that happens for this month. As for what is really helping out the boost on the day, take a look at Nike, up about 11%, a big profit beat. Their inventory fell, and the CFO is saying that they're comfortable with their current inventory, currently heading to its best day of the year. Carnival up 3% ahead of reporting earnings, expected to set the tone for travel. And then Tesla, despite the third quarter estimates being lowered to 445,000 units from about 515,000 units by Piper Sandler, well, that analyst says the stock is likely to go higher anyway, and so it is this morning.
Really strong, powerful moves from Nike going into the opening bout. Abby, thank you. Much more from Abigail around the cash open in about 16 minutes' time. Coming up, it's crunch time on Capitol Hill.
The American public has a less voracious appetite for shutting the government down than they did maybe 10 years ago. 10 years ago, I always argued the Republicans won by shutting the government down.
Team coverage up next.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
This is Bloomberg. Freedom Caucus, they'll win if they shut the government down for a couple of days to make their point. They get more border security money, and they open the government back up in about a week. Does some damage, but they end up, showing their muscle, and then border security. But it also helps Biden. This I don't understand about the Republicans. You're going to waste money with a shutdown, then you're going to get more money for border security, and Biden benefits from that.
The clock is running out in D.C. with less than 48 hours to go until a possible government shutdown. Both the House and Senate continuing work on separate stopgap measures. House Republicans still worried about their lack of a coherent message. Speaker Kevin McCarthy says they'll press on.
We work through this and get it done. I don't give up. You work until you get it done, and that's what we'll do. We're not going to walk away. We're not going to go hide in people's corners. We're going to be adults in the room, and we're going to sit down. What does it take to get there?
All this as GOP hardliners plot an attempt to remove McCarthy as Speaker as early as next week. Let's get to the team coverage. Bloomberg's Anne-Marie alongside Katie Lyons in Washington, D.C. MH, what's the state of play?
Well, today is going to be a key test for Speaker Kevin McCarthy because, Jonathan, he's going to put a stopgap funding measure on the floor. It's called, as of this morning, Spending Reduction and Border Security Act. Will keep the government open until October 31st. 30% reduction pretty much across all agencies, barring Veteran Affairs, Homeland, and Defense. The issue is, not sure if he has the votes yet, Jonathan, and that is why this is going to be very difficult for Speaker McCarthy, because if he was to then, say, potentially put on the floor the Senate's version, those hard-right members might want to oust him.
Katie, is it a shutdown or his job? Is that the choice?
It seems like that might be the choice for Speaker McCarthy, or at least run the risk of losing his job, because he has had this threat of a motion to vacate hanging like a sword of Damocles over his head for basically the entire duration of his time as Speaker of the House, John. Really, it's one individual, Republican Matt Gaetz from Florida, who has been leading this charge, threatening this motion. But the thing is, the motion would still need to pass. And I have spoken to multiple Democratic members of the House who have suggested that if McCarthy were to work with Democrats in a bipartisan measure to avoid shutting down the government or get the government funded, they would be willing to step in to help him retain his seat as Speaker. One Congressman, Jim Himes of Connecticut, told me that Democrats would do that over choosing chaos, given how chaotic the Republican Party in the House does feel at times. So it is seeming like there might be a binary choice here. That doesn't necessarily mean that Speaker McCarthy couldn't come out of it on the other side, but it does speak to the fact that he is really beholden to certain members of his party, or at least having to run the risk of going through that whole exercise.
Of course, Anne-Marie, this has not been the focus of the last 30 minutes in Washington, D.C. after the passing of the 90-year-old senator from California.
Yeah, Dianne Feinstein, Jonathan, has passed away at 90 years old. Of course, her health has been a focus, really, over the course of the last few months in Congress, and a bigger conversation about our aging elected officials. But today, the focus will be on this individual as a trailblazer and her legacy. She was elected to Congress, Jonathan, in 1992. It was the so-called Year of the Woman. And her most notable achievements that you're going to hear everyone want to talk about today is her bipartisan work on the assault weapons ban and also a leading voice for gay marriage in this Congress. So while there's going to be a lot of talk, of course, about the future of the Senate makeup and who potentially will replace her, today will really be about her legacy.
MH, thanks for the reporting down in Washington alongside the brilliant Katie Lyons. The latest on Washington ahead of that looming shutdown deadline. Dan Suzuki, we can just go through the list at the moment. Government shutdown, higher rates, higher energy prices, student loan repayments, take your pick at the moment. Dan Suzuki, the headwinds for the consumer, are they real this time? Are they actually going to hurt consumption?
Yeah, I think on the margin, John, they are going to hurt consumption. I mean, everything that you just mentioned is real, and there's more on top of that. But I think that you have to understand where we're coming from, and that's a place of incredible strength. So if you look at household net worth, I mean, we're coming off of basically all-time highs. You look at things like the financial obligation ratio. Those things are incredibly healthy. I think that there's going to be a lot of persistent resilience in the consumer, but on the margin, I don't doubt that it's going to slow. I mean, overall income growth, which is basically the product of jobs, wages, and hours, has been slowing for some time, but it's still at these really healthy levels, that are above the historical average. So I think that you got to kind of, you got to weigh both sides of this and understand that these things are going to continue to weigh on growth, but that it's not going to collapse anytime soon.
Subhadra, going into Q4, looking at volume 4 of why the consumer is about to break. Subhadra, why won't we just see even more resilience going into a new year?
We don't really, our base case is that we don't expect any resilience going into the new year. I completely agree with what Dan was saying. The consumer is going to continue to come under pressure. But we also have somewhat of a haves and have-nots, economy, where I would say that delinquency rates are rising in auto loans, in credit cards, but it's affecting a very specific cohort of the U.S. Consumers, and then you have the rest of the consumers where you probably have a lot more savings and are not in the same situation. So we'll have to track, when you track sort of the aggregate numbers, you're not seeing that kind of weakness that you should see because of the fact that we've had a very, very strong third quarter. But we believe that the summer splurge will end, and fourth quarter is when you're going to start seeing the consumer start to slow down meaningfully. But ultimately, this is an economy that's going to be led by a tightening of corporate profit margins. Corporate profit margins have declined, and I think that over the upcoming quarters, you're going to see more of that, and that's ultimately what leads us into a recession by the middle of next year.
Dan, I know you might take the other side of that, so final word, top pick in this equity market at the moment.
Sorry, say again. What was the question?
What's your top pick in this equity market, Dan, at the moment?
I think right here, I like energy. I think it's, we think that growth and energy demand globally is going to be picking up with the corporate profits recovery. I think energy is still an incredibly cheap way to play cyclicality, but there's a huge menu of things to buy right now, whether it's energy, industrials, financials, value, emerging markets. I buy the whole gamut.
That good. Dan Suzuki. Thank you, sir. Alongside Sabato Rajappa, seeing things slightly differently at the end there. Going into the opening bell, your morning calls, and later, BlackRock's Kay Moore joins us around the open on why she thinks the economy is less sensitive to higher rates this time around. That conversation just around the corner.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Stocks are positive. Let's get you some morning calls. First up, Loot Capital upgrading Bumble to buy from hold, citing the firm's cash balance, effective use of interest rate swaps, and free cash flow generation. Your second call from Bank of America upgrading AB InBev to buy from neutral, seeing signs margins are at an inflection point as cost of goods sold pressures have started to ease. And finally, Jefferies raising bull call to buy $64 price target, pointing at valuations returning to pre-COVID levels and re-accelerated free cash flow. Coming up on this program, BlackRock's Kate Moore joins us around the opening bell with her thoughts on how higher rates will impact the economy. Your opening bell up next.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Let's get you to the weekend. Your opening bell about 22 seconds away on the S&P 500. There's a lift here on the S&P by 0.75%, attempting to end this month, this quarter, this week on a high. The Nasdaq 100 up by almost 1 full percentage point. Going into Friday, it's down on the week, it's down on the month, it's down on the quarter. There's your opening bell. Switch to the board and get to the bond market. Yields look like this. Yields are down on the session. They are up big time on the month. We're down 5 basis points, 451.79 after having a little look at 470 yesterday, at about 468 at the high of the session yesterday intraday. In the FX market, the euro trying to make a comeback. What a week it's been for the single currency. Had a look at 104, had a sneak peek at 106, came all the way back down to 105.88. That currency pair firmer on the session, up by 0.2%. That's a stronger euro, a weaker dollar. And crude, 95 intraday yesterday, backing away from that level. Eventually, 92 at the moment, up on the day by about 36 cents, up by 0.4%. 30 seconds into the session, state of play. It looks like this, up 0.75% on the S&P, on the Nasdaq up by 1 full percentage point. One stock to watch at the open is Carnival, the cruise line company reporting third quarter revenue that hit an all-time high. The company's CEO saying, quote, "I continue to be encouraged with our revenue trajectory heading into next year as we see no signs of slowing from consumers." Abby had this one. Hey, Abby.
Well, John, this stock is all over the map. Now, going into the report, the stock had been higher then, initially up 8%, then very very quickly down 5%, right now up about 3%. So let's take you through some of these headlines. So for the quarter that they just report, they did beat estimates for earnings. It came in stronger. On a year-over-year basis, last year it was a big loss of about 65 cents. GAAP earnings this year, 79 cents. So much improvement there. Revenues were a little bit higher as well. They're also talking about bookings for 2024 being locked in. But what had the stock down initially or momentarily was the fact that they're now seeing a fourth quarter earnings guide of a loss of 18 cents to 10 cents, or I should put that 10 cents to 18 cents. The consensus is at a loss of 10 cents. So it seems as though investors, though, are working through what this could mean. And they're also, on an adjusted basis, talking about 4 cents to 12 cents. The consensus was at 16 cents. So I think that that's probably what has the stock higher. We'll be working through these numbers, and we now have at least Royal Caribbean. I haven't taken a look at Norwegian yet, trading up in sympathy, but it seems as though the cruise industry, a little perplexing to me, going strong.
You and I both, Avi, thank you. Their stock is up by about 4% at the moment in early trading. A decent move for that name. If you want a bigger move, look to Nike. That stock up by close to 8%. Shares rising there after the company beat profit estimates and saw a bigger than expected drop in inventory. The CFO saying this: we're very comfortable with the level of inventory in the marketplace in relation to the retail sales we're seeing. Simone Foxman on top of this one. Hey, Simone.
Hey, John. Yeah, and this end of this inventory glut seeming to be the end of discounting pattern that we have seen in the stock. And that's why Morgan Stanley is saying a bottom may be behind the company. Despite this now 7.5% jump today, we're looking at shares down over 17% year to date. So the reaction to a better than feared set of earnings coming in here. Overall revenue actually underperforming slightly, up 2% year on year. But there were signs that the U.S. consumer may not be as pressured as everyone had feared. North America accounts for about 42% of the company's business, and same-store sales falling 1%. They had been seen to be falling more than that. Europe also exceeding expectations. The concern, however, China underperforming in same-store sales, still up 12% year on year, but most expectations had been for over 15%. Jefferies analyst Randall Kotick telling us yesterday he is very concerned about the potential for China volatility, as well as some market share losses on the fringe, especially in running shoes. But the emphasis on cost cuts, margins that were better than expected, part of what's driving the surge in Nike shares today, the most since December.
There we go. Simone, thank you. The stock is up by about 8%, 7.6% right now. To Simone's point, it's all relative to expectations. And after what we saw with Dick's Sporting Goods and Foot Locker, that wasn't great at all. This is better. Jefferies aren't alone. This came from BMO today. BMO Capital lowering its price target on the stock to 110 from 120, citing growing concerns about the Chinese and North American markets. That's the concern. The stock this morning is higher by 8%. Let's turn to tech. Bloomberg reporting Microsoft discussed selling Bing to Apple in a deal that would have replaced Google as the default iPhone search engine. Ed Ludlow, how about this one?
Yeah, it's interesting, Jonathan. Apple up 0.7%. It had been up in the region of 1% in the early minutes of Friday's session. Do we draw a causal link with the Bloomberg reporting and the share move higher on Apple and Microsoft? Probably not. But according to Bloomberg sources, in 2020, Microsoft execs met with Eddie Q, who's Apple services chief. They had early stage talks for Apple to acquire Bing, Microsoft's search engine, and make it the default search engine on iPhone. Those talks were exploratory. They never reached an advanced stage. And of course, Google remains the default search on the iPhone. But the point here is that in the background, the trial is ongoing between the Department of Justice and Google over dominance of its search product. Apple and Google, the parent company now known as Alphabet, have had a search deal in place since 2002. It started with the browser for Mac, and it has expanded to other devices. And as we have learned through the course of this trial, this is a piece of business for Apple that ranges from $4 to $7 billion annually in what Google pays Apple to have its Google search engine prominent on Apple's device base. When Eddie Q, the Apple services chief, gave his testimony in recent days about Google search dominance, he basically explained that Apple and iPhone use Google because it's the best product. So this is a backward-looking piece of Bloomberg reporting. The stocks are notably higher in a market that's up 1%, I think you said, on the NASDAQ 100, John.
Yeah.
But goodness, imagine if that had gone through.
Well, it's one for the history books, maybe. And I do wonder whether the AI frenzy that's happened since changes the prospect of anything happening ever again.
Yeah, it's interesting. You know, lots of hypotheses have been put forward broadly on M&A, whether Apple would actually be able to do anything in this environment under Lina Khan's FTC. But, you know, Apple has kept quiet on the AI front in terms of a generative AI tool, consumer-facing generative AI tool or chatbot, but they've really talked up their history and competence in machine learning and AI. So I think it's interesting insofar as that, you know, Google hopes to maintain a lead in search. And the point with Bing is that it would have been a competitor. AI is now very relevant to the search market, but Bing remains only 10% of it. So it is very backward-looking, and it is a what might have been, but it also gives you a kind of lens into what Apple thinks about when it does think about M&A and when it does think about being competitive itself.
Interesting. Looking forward to the programme. As always, Ed, a little bit later, midday, noon Eastern. Ed Ludlow, Caroline Hyde on Bloomberg Technology. We're about 7 minutes into this session. We're positive still, up by 0.6% on the S&P. As Ed mentioned, we're still higher by about 1% on the NASDAQ. Let's look at food delivery services. Uber, DoorDash, losing a challenge to a New York City rule mandating an hourly rate of at least $17.96 for delivery workers. Uber saying the law will put thousands of New Yorkers out of work, and DoorDash saying, quote, extreme pay rate will reduce opportunity and increase costs for all New Yorkers. Katie Greifeld on top of this one. Hey, Katie.
Hey, John. Yeah, we're talking about the likes of Uber, DoorDash, Grubhub, etc. Like you said, they now must pay their food delivery workers at least $17.96 an hour. Of course, that's thanks to that Thursday's decision from the New York State Supreme Court. So either the companies must pay that flat hourly rate or pay per delivery at about 50 cents a minute. And as you can imagine, the pushback from the companies was immediate. As you walked through, Uber saying in a statement on Thursday that this law will put thousands of New Yorkers out of work and force the remaining couriers to compete against each other to deliver orders faster. DoorDash said that it's evaluating its legal options and that this is a deeply disappointing outcome for delivery workers, merchants, and customers alike, and saying, too, that this, quote, extreme pay rate will raise costs for all. So it sounds like the company plans to pass on those higher costs to its customers. But as you can see, the shares of both companies, both Uber and DoorDash, a little bit higher this morning. It sounds like we'll be hearing about this on the earnings calls to come.
Katie, thank you. Appreciate the update. Higher across the board at the moment. Seemingly the story up for a third consecutive day on the S&P 500. Interestingly, if we close here on the S&P for a third day of gains, that's the longest winning streak daily of the month so far, for the month of September, as we close out this month and look ahead to October. Stocks rebounding then to start the last trading day of the quarter as dovish comments from Fed policymakers ease some fears of further rate hikes. Kate Moore of BlackRock weighing in saying, quote, the dominance of services in the US economy makes it much less sensitive to higher interest rates than during previous hiking cycles. Kate, I'm pleased to say, joined us right now. Kate, always wonderful to catch up with you. A good friend of mine in a bow tie always talks about companies adapting and adjusting, and I noticed that same line in your notes too. Katie, we're underestimating maybe what they can do in the quarters to come and perhaps overestimating the importance of what's developing in the bond market.
Yeah, I mean, John, I think this is a major theme, and it's been a major theme for well over a decade, I would say, since post-GFC. Companies have been fast to adopt to changing conditions, whether that's higher policy rates, lower liquidity, changes in consumer preferences, changes in geopolitics or policy. And it just really boggles the mind that people continue to believe that companies will not adapt and change. We need to start giving, especially U.S. corporates, a little bit of credit here. And I think one of the major themes we've seen this year from some of the companies that have outperformed the broader market is they took some of the pain. You know, after share price declines last year, they cut costs, they took their foot off the accelerator in parts of the businesses that were, frankly, not going to generate a lot of growth. And they really streamlined what they needed to in terms of their operations to deliver better results. So I am a big believer in the flexibility and the adaptability, especially of U.S. companies, and I would not count them out.
Okay, can you say the same thing about financials, about the banks, given their experience this year?
I think financials, John, I know why you're asking me this, are a very different cat altogether. there's a different regulatory environment, there's a different demand environment, there's a different rates environment. I would say financials are a more challenging sector to put a lot of money behind at this moment. And I think you have to be very selective in the names that you choose.
We talked about the relevance of yields to profits, interest rates, to what's happening in corporate America. Can we talk about that with regards to the financials, Kate, with a little bit more detail if you can? Are yields and higher yields good or bad for financials? Because you and I have talked for a long, long time, for the best part of a decade together, and we'd sit here and talk about the relationship between the 10-year and where financials and stocks are priced. And Kate, where's that relationship now?
You know, it's as you know, and this is why you're asking this question, it's much more complicated. And the problem is, John, is, you used to be able to look not just maybe at the whole banking system, but at segments of the banking system and say, this group is particularly interest rate sensitive. This group is going to see net interest income and margins expand in this environment, and this one is going to suffer. But it's not quite so clear as banks have changed their operations. They've shed assets as they have, become a little bit less sensitive in some cases or less adaptable to changing interest rates environments. Not everyone is benefiting from higher policy rates. We, of course, are seeing a ton of money, as we know, flow into money market funds and people sitting on their hands there. So there's an opportunity as banks have kind of taken in, more deposits, and then their wealth management sides have seen inflows into money market. But it's not a one-size-fits-all trade, and this is why I'm saying we have to really choose our names here.
Let's choose a sector. Energy. Mark Haefele, UBS, earlier this morning, surveillance with Tom, Lisa and I, saying he likes energy. Mike Wilson, Morgan Stanley, earlier this week saying the same thing. Kate, where are you on energy names on the S&P 500?
Yeah, and I heard Dan Suzuki speak a little while ago, earlier, before the open. I agree with all of them that there are opportunities within energy, but I think we need to be realistic about it and say, even if some of these companies start generating kind of larger profits because of higher oil prices or because they continue to exert capital discipline, which has been really good for their overall sustainable profit story, there are significant headwinds on the energy side. If there are changes in demand, and we know demand has been quite strong, and that's been a major force underpinning the rise in oil prices. If there are changes in demand because economic activity slows, I think we'll see a quick reaction in a lot of these stocks. So I think you have to be more tactical in this sector. It is not a buy it, set it, and forget it. And I think you want to really stay up in quality.
Does a buy and forget it exist right now, Kate, for you and the team?
No. I think this is an environment, a market environment in general, where being more tactical and being on your toes is necessary. And I think that is going to be a dominant theme going into year end. We have all of these cross currents. You guys were just talking about stuff going on in the consumer. Some companies reporting actually fairly good activity, others reporting very weak activity, particularly from low-end consumer. And we can't just make one blanket statement around the sector or around the market. So yes, I think you have to stay on your toes, be more tactical, and spend your longer-term research hours on the big themes, but understand that you're going to have to trade around them in the near term.
Kate, it's been way too long. Let's do this again soon. Kate Moore, thank you from BlackRock on the latest view. From the BlackRock desk on the equity market at the moment, about 14 minutes into the session, a better stock market on the day relative to what we've seen over the month and a quarter. On the S&P 500 up by 0.6%, on the NASDAQ up by 1 full percentage point. Coming up, pressure building as another UAW strike deadline approaches.
This week, we've received some shocking reports of violence against our members on the picket lines. We condemn this violence that GM and Stellantis are enabling. These attacks on our members exercising their constitutional rights to strike and picket will not be tolerated.
Team coverage up next.
We have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
DHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
This week, we've received some shocking reports of violence against our members on the picket lines. We condemn this violence that GM and Stellantis are enabling. These attacks on our members, exercising their constitutional rights to strike and picket, will not be tolerated. Let me be clear. Fighting for economic and social justice isn't a crime. It's our civic duty.
Tensions rising on UAW picket lines as the strike hits its 2-week mark. Union President Sean Fain calling out GM and Stellantis for alleged violence. Automakers pushing back, GM calling Fain's remarks inflammatory. Stellantis saying, quote, the companies are not the enemy. We are not at war. At 10 a.m., Fain is expected to announce another round of strikes starting at noon if automakers don't budge. And this time, Ford won't be spared. Union pay raise demands sliding down to about 30% based on our reporting, with counter-offers remaining at around 20%. Let's get to the team coverage. Bloomberg's Anne-Marie in Washington, D.C., the brilliant Shelley Banjo here in New York. Shelley, first to you. How wide is the spread between automakers and this union right now beyond just what is offered on pay?
So they came out saying we want 40% or north of 40%. The car companies came out with 20%. Our reporting this week revealed that a palatable number, a key target, would be that 30% number, that the unions could feel confident in, that they could really get, really come back and bring that back to their members as a win. But there's so many other issues. There's things like pensions and job security and temp workers, and there's a number of issues at the bargaining table, not just that top line pay number.
Shelley, Ford out of the firing line from some of those more prominent comments we cited just moments ago. Are they in the firing line in about 10 minutes' time?
That's what we're going to see in just a few minutes to see if they name another Ford plant. What happened last week was they said, okay, we're seeing some progress at the bargaining table from Ford, so we're going to spare them. But they didn't stop the strike that they had already going at the first Ford plant. So they're really, this whole strategy is around flexibility to show publicly what kind of, respond publicly what the progress is at the bargaining table.
AMH has been quite a week, hasn't it, with the President of the United States at the epicenter of a lot of this stuff.
That's right, Jonathan. The first time ever you see a president go to the picket line, voicing his support
going beyond really just putting his thumb on the scale towards the union workers. And yesterday he tweeted that they should stick with it. And in this tweet, Jonathan, you see a video of the president, and there's one line that really struck out to me. He says, "We save them," meaning the big three. "It's about time for them to step up for us." And what is so delicate at this moment right now, Jonathan, for the White House is that potentially we're going to see expansion of these strikes, as we just heard. On top of that, we are less than 48 hours from a government shutdown. And if you include $100 for a barrel of oil, that is the difference between a recession or not, according to Bloomberg Economics.
Amazing. AMH, Shelley Banjo, thanks for the update, guys. Appreciate it, as always. The big debate continues. Are those strikes going to be extended, prolonged, deepened? We're going to find out potentially in about 9 minutes' time when we get that UAW news conference, if we can call it that Facebook Live event taking place at 10 a.m. Eastern Time. The broader market going into all of this is doing okay. 8 minutes away, or rather 8 minutes away from that happening, 22 minutes into this session. Equities are up here by 0.6% on the S&P. The Nasdaq higher by more than 1%. Abby has the sector price action. Hey, Abby.
Hey, John, and it's solid sector action. Actually more robust, I would say, than the overall gain of about up 0.6% for the S&P 500. In other words, risk on. You have discretionary, tech, real estate, and utilities all up more than 1%. These are some of the most rate-sensitive sectors. So right now, getting a bid to the downside has been this quarter's big winner. Down 1% is energy. Let's turn right to the quarter because we are, of course, looking at the best quarter, the worst quarter in a year since this quarter last year. Energy up 13%, the one of three sectors that's higher, the most since December of last year. Utilities, John, down 8.1% as those dividends look less attractive. That's the worst quarter since March of 2020. And then we also have real estate, also a dividend-sensitive sector, along with commercial real estate issues, down 8.4%, the worst sector in a year. So quite a bit of drama this quarter. Let's see what the fourth quarter brings.
This has not been a September to remember for good reasons, that's for sure. Abby, thank you. About 23 minutes into the session, then equities higher on the S&P and on the Nasdaq as well. The potential for a third day of gains. Your trading diary up next.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
25 minutes into the session, equities higher for a third consecutive day. A three-day winning streak on the S&P, the longest winning streak of September so far as we close out this month and go into October. We're facing the potential of a fourth week of losses on the S&P 500, with this move now just about positive on the week over the previous 4 days, including early this morning. The S&P higher by 0.6%. That's the price action. Let's get to the trading diary. The week ahead, the day ahead looks like this. UMich consumer sentiment at the top of the hour, plus UAW President Sean Fain making making an announcement on Facebook Live. Saturday, the government shutdown deadline coming at midnight. Tuesday, FTX co-founder Sam Bankman-Fried's sweeping fraud trial begins. And Friday, the September payrolls report, which could well be delayed, if Congress fails to fund the government. From New York City, that does it for me. Thank you very much for choosing Bloomberg TV. And as always, good luck for the rest of the trading day. This was the Countdown to the Open. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Friday morning from the
Bloomberg's HQ headquarters.
731 Lexington Avenue,
in
New York City.
Absolutely. We are just getting poured on here in rain, but we will make it through. Coming up, we're going to get the latest from Speaker McCarthy. He's scheduled to speak in just moments, and we'll bring that to you regarding the shutdown. We'll have some reporting on that as well. John Hurdle, Executive Vice Chairman at Hurdle Callahan, talk about these markets going forward. And then Tom Farley, CEO of Bullish and former president of the NYSE. He wants to talk about crypto. We always like talking about crypto, so that'll be good. So that's coming up in this hour as well. But first, let's go to John Tucker, get a Bloomberg Business Flash.
All right, Paul and Matt, we're data dependent, so let's try to bring up the latest data from the University of Michigan. The sentiment survey, higher than expected, this sentiment. I go right to the inflation expectations. That is right on target, 3.2% for one-year inflation expectations. The 5 to 10, 2.8%, right on target in terms of analyst projections. Investors focused this morning the rate of inflation. Earlier, we got the Fed's preferred measure of inflation, registering the smallest monthly rise since late 2020. Risk assets all getting a boost as a result of that, especially technology. Julian Emanuel at Evercore ISI tells us stock investors this is the time to buy.
When you look long term, the reason the market is likely on better footing in the fourth quarter is because earnings are going to continue to grow next year.
And right now, the S&P 500 up 32 points, a rise of 0.75%, 43.32 on the index. The Dow Jones Industrial Average up 111 points, that's up 0.3%. NASDAQ 100 up 191 points, up 1.3%. Better than feared earnings, driving Nike shares higher this morning. Blue Apron also being acquired by Wonder Group. That's a price tag of about $103 million. Shares there, they are soaring this morning, up 133%. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you so much. We appreciate that. Matt Miller, Paul Sweeney, live here in our Bloomberg studio, streaming live as well on YouTube. So head over to youtube.com and search Bloomberg Radio. We're waiting for Speaker McCarthy to make some comments, presumably about the pending shutdown. And when we get the speaker, we will bring those comments to you. In the meantime, let's go to Zach Cohen, a Bloomberg Government Congress reporter. Zach, I guess it's kind of inevitable here that this government's going to shut down. Is the debate moving over to for how long?
Yeah, it really does seem like, absent some sort of miracle, the question is not whether the government will shut down, but how long it will be shut down. The House is trying to vote on a stopgap measure that was released late last night. Not necessarily a continuing resolution. It would actually cut domestic spending pretty drastically by almost 30% over the course of the month that stopgap would be in place. But the Senate's unlikely to take up that bill. They've got a bipartisan one that includes current funding levels, aid for Ukraine in its war versus Russia, and that measure, senators are hoping to send over to the House over the weekend. And then it just becomes a question of how do the House and Senate come to some sort of agreement to reopen the government at that point.
So what will be the first things that we notice, that average citizens notice in the government shutdown? I've heard a lot of concern that Fat Bear Week could be canceled. The national
That's
parks.
Right.
You've heard that as well. And I actually have heard that the Panda Cam might come down, which would be a horrible tragedy, considering this is like our last year with the pandas as well.
Right. Really, any non-essential government function would stop. And so, for instance, I'm on the Hill today. Capitol Police would continue to guard Congress, members of Congress would continue working to try to fund a way out of a government shutdown. But across the country, not just in the Washington area, but federal workers would be decided as essential or non-essential. And those that are quote unquote non-essential would be sent home without pay until the government reopens. And those that continue working would not get paid until the government reopens. And in some cases wouldn't get paid at all if they're contractors. You can see that on military bases, VA hospitals, passport processing, maybe. There's a number of ways that obviously the federal government is an important part of Americans' lives. And less staffing in a lot of those offices is going to inevitably have some implications for Americans on a day-to-day basis.
Zach, I mean, you think from a political perspective, it just feels like the Republicans are really leaving themselves exposed here. Do you have any sense of what their political calculus is here?
there's a bipartisan majority in the House that wants to fund the government. The issue for Speaker Kevin McCarthy is he's got this band of more fiscally conservative members of the House Freedom Caucus that are basically saying, look, unless we cut government spending in the long term, the U.S. debt is going to be unmanageable, and we need to tackle this now.
That's not wrong.
Given the fact that the fiscal year is coming up as a natural negotiating point to come up with some sort of long-term funding deal, at least for the next year, and then beyond that. Now, the debt ceiling was supposed to address some of that, but some of these more conservative members are looking to extract even further concessions. And in procedural votes, they have a lot more power because Democrats tend to not support Republicans on those procedural votes. And so Republicans are trying to get all on the same page before they can go to Democrats in the Senate with some sort of long-term or even short-term spending deal.
So I've heard whispers, I think on surveillance actually, that the conservatives may want to just throw out McCarthy and bring in Tom Emmer, who now is the majority whip from Minnesota. Have you heard anything about that? What's our reporting tell you there? And it also begs the question, you know, if McCarthy's days are numbered, why not do a bipartisan deal for the sake of America and keep the government open?
I mean, one of the big questions for the last couple of weeks is to what extent would McCarthy, Buck, members of the House Freedom Caucus put a bipartisan stopgap bill on the floor, potentially enrage them in the process and have them trigger a so-called motion to vacate. But they haven't done that yet, although there was some reporting, as you mentioned, the Washington Post, that members of this House Freedom Caucus are starting to rally around maybe trying to promote Tom Emmer, a Minnesota Republican and the number 3 in House Republican leadership and the former chairman of House Republicans' campaign arm, as Speaker, if they were able to force a motion to vacate, remove Kevin McCarthy as Speaker, and then move on to the kind of balloting that we saw in January when it took a week for even McCarthy to get the gavel. There's been some talk about, you know, do Democrats come in and save McCarthy in order to come up with some sort of long-term government funding deal? But Democrats so far have been pretty clear that they have no interest in trying to throw Republicans a political life raft. And then in the majority, they've got to come up with a solution to this.
Just a red headline crossing the terminal. Governor Hochul declares state of emergency for New York City. That's according to ABC, and we'll have some more reporting on that. But I can tell you, it's raining like crazy here.
Well, we got an emergency alert earlier, just about 45 minutes ago. Did you see that?
I did not.
On your phone? You should have gotten on your mobile phone an emergency alert that said from the National Weather Service, a flash flood they're warning of a flash flood until 12:30 p.m. and they're saying do not attempt to travel unless you're fleeing an area that is subject to flooding or under an evacuation order.
Yeah, great. And the subways are impacted as well. So, you know, Zach, explain to me and our listeners how 5 members of the House can have so much influence and impact on the broader U.S. government. I just don't get the math.
So the House usually operates on something called a rule that gets placed on the floor. Before they can get to final passage of any bill, they basically have to set the terms of debate that actually create the floor that a bill can pass with a simple majority. And remember, Kevin McCarthy only has a 4 or 5 seat majority. Smaller than that when he's got members who are out sick or in one case had resigned due to some family emergencies. And so on those rule votes, Democrats usually vote against them. Republicans did the same when Democrats are in the majority. It's a longstanding practice in the House of Representatives. And so on those rule votes, McCarthy has very little wiggle room in order to get that floor debate set up, which then sets the final, sets the path for final passage of these bills. And that's why over the last couple of weeks, some of these fiscal 24 funding bills for things like the Department of Defense, Department of Agriculture have been tougher to get across the House floors because it's actually been defeating the rule rather than the bill itself. And that's usually been done in protest, either of the contents of the bill itself or as part of this larger debate of enough House Freedom Caucus members saying that Speaker McCarthy is not extracting enough concessions from the Biden administration, the Senate, Democrats, or generally bringing up funding bills that are small enough.
Zach, we also received the news this morning that Senator Feinstein of California has passed away. What's the feeling on the Hill today? Have you kind of interact with anyone to give you a sense?
I did run into a former House Speaker, Nancy Pelosi, on the way into the Hill today, visibly emotional by the news that Senator Dianne Feinstein at 90 passed away last night, a fellow California Democrat, and noted that Feinstein, in her last day in office, actually voted to advance a Senate bill that could end the government shutdown. And so certainly some sadness here. Senator Feinstein has been around for a long time on the Hill, but obviously has had serious health complications over the years, including a very bad case of shingles earlier this year that actually took her out of Washington.
All right, Zach, thanks very much. We really appreciate that. Zach Cohen, Bloomberg government reporter. Let's go down to Washington, D.C. right now. Speaker Kevin McCarthy making his remarks.
Thank you all. Moments ago, the flags over the Capitol were lowered in memory of Senator Dianne Feinstein. As California's longest-serving senator, Senator Feinstein broke barriers and blazed a trail for women. Her career was, by any standards, historic. Speaking personally, I worked with the senator for quite some time, together on many different bills, but the one that I think stands out was our water legislation. It was historic. It was the first time in California history in more than 25 years that we were able to pass water. It was the WIN Act. And I remember the hours and the nights that we would have to work to try to work through, and the challenges. We come from different parties, we have different philosophies, but we put our state first. At the same time, Barbara Boxer opposed it. It was one of the last votes of the Senate. It had more than 70 votes at the time. And I believe at the end of the day, the trailblazing of the first woman elected mayor, even coming from a different party, inspired women from both sides of the aisle to seek elected office and to have their voices heard. My deepest condolences to her family, her colleagues, and to her staff. Last night, the House did something none of you sitting here thought we can do. The number of questions I could take in the number of weeks about doing appropriation bills. I told you, don't give up on us, because we're not giving up on the American people. We passed 3 appropriation bills: defense, state, and foreign ops, and homeland security. My biggest question is, I don't understand why the Democrats voted against funding the government. In all, we have 4 appropriation bills done. There's 12 overall to get done. It's the discretionary spending every year that government is supposed to do. We have now in the House passed more than 70% of the discretionary spending on appropriations. Need I remind you, how much has the Senate passed? 0. Not one appropriation bill has passed the Senate. We've done what many have said was impossible. When I became Speaker, I said we're going to change Washington. And we did that by keeping our commitment to restoring regular order. Bills that passed committee in June and July have been open for amendments for months. Struggled with a number of members who wouldn't allow it to come up, but I never gave up. 440 amendments were considered on the floor this week. And for those who are historians, we are the first Republican majority to pass the State and Foreign Ops Bill through regular order since 2006. My entire political career as a member of Congress, the Republicans have never been able to do what they just did last night. As we continue to get conservative wins and return to regular order, we actually need a stopgap measure to allow the House to continue to finish its work, to make sure our military gets paid, to make sure our border agents get paid as we finish the job that we're supposed to do. Another reason for the stopgap is to address President Biden's historic failure on the southern border. This is how bad things have gotten under President Biden's watch. In 5 days, there's been more than 50,000 illegal border crossings. Put that in perspective, in just 5 days. That's more than twice as much as the average for the entire month in the last administration. A wide open policy hurts America. We've heard it from Democrat leaders across the country. But despite the chaos, the president still won't go to the border, setting new records every day. Fentanyl at an all-time high, killing Americans, and he refuses to go to the border. He's been one time in 50 years. One time in 50 years, he's had more dinners with Hunter Biden's foreign business partners than he has going to the border. Think about that for 1 minute. Something he said he's never done. He's done more than he's ever been to the border in 50 years as an elected official. He was less than 200 miles from the border this week in Arizona. Less than 200 miles. And he couldn't even stop by for an 87-second photo op. Really makes you believe that President Biden is deliberately letting this happen and trying to continue to ignore it. If Biden won't visit the border, why won't he at least listen to the Democratic leaders that are elected across this nation? Mayors of New York City says Biden's border policy will literally destroy the city of New York. Governor of New York says illegal immigrants should go somewhere else. The governor of Massachusetts declared a state of emergency. Mayor of El Paso says the city is at a breaking point. Mayor of Eagle Pass, Texas, says President Biden has abandoned them. Not one of these individuals is a Republican. Why does President Biden and congressional Democrats continue to ignore the border and ignore their own leaders? That is why I'm putting on the floor a stopgap measure that will fund the government and secure the border. No longer can the president ignore a problem he created that kills Americans every single day, destroys some of our greatest cities, and puts states in a state of emergency. Every member will have to go on record of where they stand. Are they willing to secure the border, or do they side with President Biden on an open border and vote against a measure to keep government open? House Republicans are working through an impeachment inquiry to hold this administration accountable. Yesterday, we heard from expert witnesses who said that there is enough evidence for an impeachment inquiry. Jonathan Turley, he said, and I quote, "I do believe that the House passed the threshold for an impeachment inquiry into the conduct of Joe Biden." Bruce Dubunski, the forensic accountant, "As a fraud investigator, when I see smoke, I immediately look for the fire. Why were members of the Biden family and close business associates receiving millions of dollars of payments from foreign entities and individuals?" Republicans have been uncovering the Biden family culture of corruption, and we will follow the facts wherever they lead. Again, remember, as the president ran for office, he told us he's never talked to his son about any of the business. We now know that's a lie. Not only did he make phone calls in, he had meetings. There were benefits for those dinners. A new Porsche, more than $3 million from a Russian oligarch, travels to 9 family members. As Chairman Comer announced, we are moving forward with subpoenas for Hunter and James Biden's personal and business bank records. The American people deserve to know the truth, and that's exactly what we're doing.
All right, that was Kevin McCarthy, Speaker of the House, talking ostensibly about the shutdown, but also kind of putting some political points there. As
he was
well.
venting.
He was venting, and he's probably, from his perspective, has a lot to vent about. Zach Cohen rejoins us. He's Bloomberg Government Congress reporter. So, Zach, a lot going on down in Washington today. It's probably going to be interesting to see how people prioritize what we've heard. Obviously, the unfortunate news of the passing of Senator Feinstein, the pending shutdown of the government, and then obviously just the regular day-to-day politics and back and forth between the two parties. It's going to be interesting to see how this all gets prioritized.
Right. The Senate actually is not even voting again on a stopgap bill, probably until Saturday morning at this rate because of some procedural hurdles that Senator Rand Paul has thrown up in response to the Ukraine aid that's included in that bipartisan bill. But I should note what Speaker McCarthy brought up in terms of the border. That's an important political issue and part of the reason why we are headed toward a government shutdown. You all will recall in 2018, 2019, when the government shut down in that changeover from Republicans to Democrats in the House, while then President Donald Trump was president, that the shutdown was really about border security. And we're seeing that again here, where Republicans, in a bid to boost border security against a Senate and a White House that is a little more critical or at least skeptical of those policies, that is part of the reason why the entire government is shutting down, because those border politics are being wrapped into the rest of these government funding bills.
And Zach, is there any feeling in Washington, D.C. that the Biden administration has not done a better job dealing with this border issue?
It seems like Democrats have been waiting on House Republicans to come up with this sort of first negotiating position on anything that would fund the entirety of the government. The bills that Speaker Kevin McCarthy talked about that did pass late last night, only just passed late last night. They had only passed one of their government funding bills before the August recess, and then passed a couple of more last night, but they were largely along party lines. And so their fate in the Senate is pretty much done. And so Democrats have not really wanted to start negotiating with House Republicans on some sort of bicameral deal until they knew that House Republicans could rally around some sort of negotiating position and eventually, hopefully, a final compromise.
But is funding the main problem that this administration has faced? I mean, you know, they've been there for a couple of years and they still haven't managed to deal with this issue. We continue to have record numbers of illegal immigrants coming across the border. Why aren't they doing a better job?
And that's part of the reason why I think Speaker McCarthy brought up New York Mayor Eric Adams' comments that the influx of migrants to cities like New York are really straining the social resources there. The issue becomes that comprehensive immigration reform has eluded Congress for years, not decades. There was an effort about 10 years ago on a comprehensive package that passed the Senate and then died in the Republican House. And there are fits and starts of some sort of bipartisan agreement that would tackle not just border security, but also some sort of fix to the larger immigration system that both sides recognize is broken. And so Republicans have been skeptical of any sort of immigration reform without border security and vice versa for Democrats. So there's bipartisan interest in both of those issues, but getting to some sort of formal agreement between Democrats and Republicans is really, really tricky.
Zach, once we go into a shutdown, assuming we do that on Saturday night at midnight, what kind of work is done to sort of dig us back out of that hole? I imagine it's not the case that everybody in Congress just goes back home, right? They must continue to somehow work on solving the issue.
Members of Congress are scheduled to be in session next week. That was always the plan. A number of their staff would be furloughed, and so they'd be working with sort of skeleton staff up here on the Hill, and so they would have fewer resources to try to handle this issue, although they could always bring folks back if they thought it was the constitutional prerogative of needing that staff in order to get the government reopened. But there's other impacts. The Congressional Research Service, for instance, the sort of in-house think tank for Congress would be closed with the exception of maybe putting out a few papers on appropriations. Members of Congress still get paid in the shutdown. That's a constitutional prerogative. There are members who could opt to donate their pay to somewhere else or have it withheld temporarily. But that will continue until they come to some sort of agreement. Federal employees would also get back pay. That's mandated. But federal contractors who work for the federal government would not necessarily get that back pay. There's an effort to try to make sure that they're made whole at the end of the day, but that's not a given.
All right, Zach, so does midnight Saturday, between now and midnight Saturday, are any meetings taking place, or is this thing just going to quietly expire at midnight and then everything kind of shuts down?
Yeah, the House is going to try to pass the stopgap measure. The Senate's going to try to pass its own, but we haven't seen really any sort of substantial conversation between the two chambers. Certainly plenty on the Senate side between Democrats and Republicans, but certainly not between McCarthy and Schumer, for instance, that we've heard. The last time I've heard they spoke was in July, at least on a stopgap measure, although I'm sure their staff are in much closer communication on daily congressional matters. And McCarthy has talked about wanting to meet with President Biden to talk about a way out of a shutdown, and that meeting has not happened. They haven't spoken, I believe, since the debt ceiling was agreed to, and that was President Biden's argument. It says, why meet with Speaker McCarthy? We agreed on funding levels in the debt ceiling deal that passed earlier this year that avoided a default on the U.S. debt. And so, no, it doesn't seem like there's a lot of, at least publicly, conversation happening right now between Democrats and Republicans. I anticipate once the House and the Senate come up with their respective stopgap measures or proposals to reopen the government at this rate, then you could see some actual conversation. I think a lot of that's happening in the Senate. The Senate Republicans are hoping to get some border language into a funding bill they hope can pass the House. It's just a question of whether the House would actually go for that and if Senate Democrats would go along with it.
Zach, just want to quickly ask a question